Okay. Let me see if I got this. Uh-oh. Unplug myself. Okay. I am getting my microphone going here. Oh, here we go. All right. I accidentally unplugged the mic, so I've got that working now. Got a little better lighting in my office, so I think that's helping a little bit too. And I'm using a system called StreamYard, that allows me to kind of put the video in a couple different places. So this is a test run with this new system, and hopefully it's posting to my YouTube and my Facebook. Both boxes are checked. I think it's all set up. So my name is Ryan with Patriot Home Mortgage here in St. George, Utah. I do lending in Utah and Nevada. Patriot can do lending in a bunch of different states. So if you need help outside of Utah and Nevada, I can direct you to the right person or help you get the right answers. But I just like helping people with mortgage financing. I've been doing home loans since 1999, and I just like to share my expertise and just have some fun learning some new skills on how to do videos and lighting. And it's just been kind of a fun process learning how to be a little more on the content creation side of things. So thought it'd be helpful to just try out this new system today. I wanted to focus a little more on first-time home buyers, but any questions are welcome. You can put a question into the channel, and it should pop up on my screen, hopefully. If anybody's watching, if you can test it by throwing a comment, a hi, a hello, or whatever it might be. I'm not sure if it's, I just hope it's broadcasting. I don't know. This is my first run on this, and I think it's recording it, so worst case, I should be able to post it, I think. I don't know. We're going to find out. So if you can see it, let me know what platform. This is a brand new thing. It's called StreamYard. It's supposed to be on my Facebook and my YouTube channel, hopefully streaming at the same time. But this is the first time I've used this system. So, but I did get a little better lighting. If you can see, my office is lit up a little bit better. I still probably need to upgrade the camera. So that's probably the next thing. I got a little better microphone. So if you can hear me, say hello. But let's go on to some questions. So one of the most common questions I saw today on first-time home buyers is, what are the most common mistakes? That form of that question was out there like crazy. So I thought that must be something that people are looking at or curious about if they're first-time home buyers. So let me back up one step. What is a first-time home buyer? Now, when you hear first time, you think ever. But you're classified as a first-time home buyer when it comes to mortgage loans if you haven't owned a home or been on title or had a mortgage or anything like that. You have to be, doesn't mean you haven't had a mortgage, but if you're on property more than 3 years, then you're reclassified as a first-time home buyer. So let's say you bought a home 5 years ago and you haven't owned a home since, even though you may have owned 100 homes before then, you're actually reclassified as a first-time home buyer. So if you haven't owned a home in the last 3 years, you are now classified as a first-time home buyer. And why is that so important? Well, there's certain programs that do open up. There's certain guidelines that change a little bit for first-time home buyers, and that's really kind of the major thing. And there are certain programs that are kind of targeting people that are first-time home buyers, but they can't discriminate on certain programs if you are or not first-time home buyer, your age, or those types of protected classes. So really it just helps with some of the guidelines if you are a first-time home buyer. So one of the most common mistakes that first-time home buyers make is transfer jobs or quit jobs, that type of stuff, a lot within the last few months as they're preparing to buy a home. You wouldn't believe how many times I see people that jump around. They're usually in that age group. They've got different opportunities and they're kind of bouncing around, getting settled. And that's one of the guidelines that gets expanded under first-time home buyers, knowing they have more of a tendency to be moving careers from school, finding a job, that type of stuff. So you do see a little more of a crazier job history. When we do a mortgage application, we were going to get a 2-year residential history and a 2-year job history. And if there's just a whole bunch of jobs on there, it can be a little bit of a red flag that the income is not consistent. Plus, if it's only been 1 year or 6 months you've been on the job, they won't let us use short-term or stuff we don't have a long enough track record for. This would be things like overtime, bonus, commission. They want to see a longer track record of those types of things. Now, there can be exceptions if you're in an industry that has a lot of overtime, like nursing or oil fields or stuff like that, where it's more built in. But generally speaking, they're only going to use your hourly wage up to 40 hours to qualify for the loan. Especially if you're self-employed. That's a whole nother can of worms, because they want to see a 2-year tax return to, one, make sure the business is viable and it's going to continue, because most businesses fail before the first 2 years, or very temporary LLCs or stuff like that. And usually a lot of expenses are associated with the first year of starting a business, because that's when you're buying products or machinery or whatever it is for that particular business. But we have seen more people go to DoorDash and Uber and stuff like that, that's kind of self-employed 1099 contractors that maybe not have a expense that's tied with it that first year. But really, we're always looking at 2-year histories for residential, employment, that type of thing. And the more consistent those things are, the better it is in that category. The other big mistake I see that people do is they will do credit inquiries after they apply for the mortgage loan. They'll go out and get maybe a store card of some kind, or an RC Willey or a Furniture Row or Ashley Furniture Store or something like that, because they're excited they got pre-approved. So now they think they can go and get their furniture or appliances or even a new car. I see that happen all the time too, because they hear, okay, we're pre-approved, so I'm good. That doesn't mean you're approved. That just means what the information we have at that time, if it holds true and we can verify it, then you'll be actually approved for the mortgage loan. So just communicate with your loan officer. That, I would say, is probably the next biggest tip, is you're not supposed to know how all this stuff works. So communicate with your loan officer, tell them what you're doing, him or her what you're doing, and just run it by them first before you open up new accounts, move money around, open up a new credit card, any of those types of things. You want to have those conversations first. Next is get a home inspection. A lot of first-time home buyers don't necessarily have as much money in savings, or they're doing 100% financing, but they might skip that home inspection. And I tell you what, it's not worth it. You're doing a huge investment. You're buying a big house, big payment, big loan, like probably the biggest loan you've ever had in your life up to this point. And so do the home inspection. It's worth it, even if it's just cosmetic things, just good to knows about certain things. But there is times you'll find something that can either decide to cancel the deal or go back to the seller and say, hey, I want that fixed before we buy the house, or negotiate the price, something like that. So I would say a lot of first-time home buyers, because of finances or whatever, they don't want to pay that out-of-pocket expense for the home inspection. And it's worth its weight in gold or more, especially if they find something that makes you lean towards not buying the house, like buying a lemon or just having a bunch of problems with the electrical, the plumbing, whatever it might be. So really, the home inspection is really, really critical. But communication's crucial. People have this weird perception that they're supposed to know how all this works. And they'll make assumptions that make it harder on themselves. Like they'll move money around, they'll close accounts, they'll do all this stuff. Then now we have to paper trail all of that. And so before you do anything, just ask your loan officer. You're not supposed to know how this stuff works. We're open to questions. We want to help you make this process as easy as possible, and we're on your team. Nothing you tell us potentially is going to be a deal killer. Now, if there's fraud or you're doing something like that, that's a whole different ballgame. But asking questions is not going to cause a problem. It's not like the loan officer is going to go, well, you should probably know that by now. We know you're not supposed to know how this stuff works. I mean, if I wasn't in the industry, I wouldn't know how half this stuff works just by my parents' loans or my friends. I mean, how would I know any of this stuff without going through the process? And it can change. The loan your parents got 10 years ago is not going to be the same kind of loan you're going to get today, with how it gets underwritten, how you sign documents with electronic signatures and mobile apps and all the technology that's changed. Loans change as well. The guidelines, the terms, all that changes as well. So ask questions. Don't feel, and if you feel like you can't, you're using the wrong loan officer. Because if they're not open to questions and they're not willing to help you and be teachable to you or helping you learn, you're probably using the wrong loan officer. So it is something where ask those questions. If you don't feel comfortable with it, ask me, I'll help you with it, or ask somebody else. But that's what we're here for, is to help you with this process. And I've said it already a couple times on this video, you're not supposed to know how this stuff works. That's why you have me, you have your agent, the title company, all the pieces that come together to help you with this. That's our job, is to help you walk through the different loans you qualify, the underwriting guidelines, the The reasons why we need paperwork and the reason why we need it will help you get the what you need. The most common thing I see that people do wrong is bank statements. So let's talk about that real quick. Whenever you put earnest money down or you are putting a down payment down, we have to source and season those funds for 60 days. So we have to know where it came from. So if we get your bank statement and there's this $30,000 deposit out of nowhere, they're going to want to know where those funds came from. Maybe you sold a car or a home, or maybe it's a gift or an inheritance or a bonus or whatever it might be. We still have to source and season those funds if they're within the account within 60 days. If they've been in there for 60 days, say it's an IRA or 401k or just your savings, that's fine. But you can't just take a bunch of cash, like you've been stuffing it under the mattress, or a family member just gives you a bunch of cash. We can't use it. There's money laundering laws. There's all kinds of things that restrict our ability to use those funds until they've seasoned or we verify the account they came from. So if you are getting a gift, if a family member, an inheritance, or is helping you out, the best thing to do is leave the money where it's at right now. Then we can just verify it's in mom and dad's checking account, savings account, wherever it is. Then we don't have to send the money until you're ready to close on the house. We just have to verify where it's at. But if it goes from mom and dad to you and then to someone else, and then if it bounces around, every step we have to verify where that money's been moving. It can just be a paper trail nightmare that can be avoided by simply just leaving the money where it's at and letting us verify it. Now, that's one sticky issue that donors don't want to have to provide their bank statements and things like that. But that's what we have to do to verify those are good funds, that it's not a loan or another deposit came to their account, then another deposit. And a lot of this comes into anti-money laundering, Patriot Act, all this stuff, because a lot of times real estate can be used to launder money or to filter money through our system. So a lot of these anti-laundering laws fall into our industry as well, especially for home ownership. So the easiest thing to do is just kind of leave the money where it's at, source and season it, or get it into your account, but then you have to wait 60 days to use those funds. And I know parents don't want to just have the money sitting in their kid's account when it can stay in their account earning interest or index funds or wherever it might be. So that's why talking with your loan officer is really crucial, and why starting the pre-approval early is really, really smart, because we can address these issues now while you're out trying to shop for a home. The worst thing to do is call up a loan officer and say, well, my lease expires in 30 days. I'm getting a gift funds. I've just changed jobs. I've just bought a new car. All of those things really tightens up the type of loan program you're going to have and limits what we can do to fix it or season or that type of thing. So generally, if you're within 90 days, that's when I would start getting the loan stuff handled. So that way you're just ahead of the curve. Plus, if you get all that paperwork done, you can submit an offer to the seller where you can close faster and sooner. So maybe your offer is going to stand out because you don't need 30, 40, 60 days to close. You can close in 20 days or 15 days. So that'll make your offer stand out a lot if you already have your ducks in a row. So don't wait till your lease is expiring. Don't wait till your last month of your lease. Start the process early. Also, will give you more time to be shopping and make sure the right home hits the market. But we're kind of a microwave society. Procrastination, wait to the last second, but it really does hurt you when it comes to the type of mortgage loans that are out there. So submit questions in the comments. I hope that works. Again, this is StreamYard. It's a new service I'm using. I really like it if it's working because it does allow me to stream to different platforms. But I tell you what, the lighting made a huge difference. Now I just got to maybe upgrade the camera. The microphone's okay. I got kind of I don't know what this thing is, a Blue Yeti, I think is what it's called. So hopefully it's sounding better. But I'm just trying to work on making it look a little bit better. And that's just my office here right on Bluff Street. And so I'd love to earn your business if you're looking for a loan to buy or refinance in Utah and Nevada. That's where I'm licensed. But Patriot Home Mortgage is licensed in a bunch of different states. So I've been able to help or direct people to where somebody can help them. So let's jump into some questions here. If you have any, you can jump into the comments. All right, let's see if we can find another question. Yeah, there's a lot of questions about what's the most common mistakes, what's the most common things they do to make things harder on themselves. Not asking questions, like assuming, I think, is a big part of it. Before you do certain things, don't just assume, oh, this is going to help me with a loan. Paying down debt. So they say, well, if I pay off this car, if I pay off this, it'll help my credit score, it'll help this and that. Sometimes it does, sometimes it doesn't. Sometimes having the money in reserve is better. So it's just have a conversation with your loan officer can make sure you're not shooting yourself in the foot. I've had so many times where people do something. I'm like, where did you hear that that's the right thing to do? It's not necessarily wrong, but it doesn't really help you. In some ways, it can hurt you. So just have those conversations with your loan officer first. That's why starting the process of pre-approval first is so, so crucial. First and early. Do it first and early. All right, let's see what else we've got. I found a couple other. Let me scan down here. I saw another one I really liked, but now I can't find it. Do realtors like first-time home buyers? They like representing. I mean, I guess it depends on every agent if they gravitate towards first-time or So I wouldn't say yes or no. I think it really does depend on the agent, and I think I would say maybe a little towards no, because there is that lack of experience. Depends on how experienced the agent is. So I think it's a really broad yes or no, but I'd probably say a little more towards the no for most agents, because there is just a little more education, a little more time that has to be taken, and first-time home buyers are usually in the lower end of the market where there's a lot less homes in that price range. So I would say that's probably more price point and first-time home buyers is where you'll run into an issue more so than just a first-time home buyer. Because I don't even know, unless you just assume by their age, they come in and they're a young couple, you might assume they're first-time home buyers. But again, first-time home buyers are anybody that haven't owned a home in the last 3 years. So anybody who walks in your door could be a first-time home buyer, but it is more that young couple that maybe they don't have their expectations quite right, or they just can't afford much that's in the marketplace. So that's where the agents really should spend time making sure they're pre-approved before you run them all over town and find out they can't qualify for anything they're looking for. And most agents realize that. They're going to make sure that you take that first step first, because it just makes sure you're not wasting your time looking at a house you can't afford. Last thing you want to do is go out and look at an $800,000 house and realize what the payment is and be like, oh, I can't afford that. So you want to make sure that you're looking at homes that fit your price range. Here's is 28 too old to be a first-time home buyer? That's an interesting question. So no, it doesn't have anything to do with your age. You could be 90 and be a first-time home buyer, not only if you've never owned a home in your entire life, but again, if you haven't owned a home in the last 3 years, you are now a first-time home buyer again. So that the classification of that can be a little bit unique. But no, you don't have to be a certain age to be a first-time home buyer. You have to be a certain age to be able to sign the contract. So in most states, you have to be 18, a legal adult, to sign the contract for a mortgage. But after that, there's no restriction. In fact, there's no restriction on the term of the loan. Let's say you're 90 years old, you can still get a 30-year fixed. We cannot discriminate other than legal age for the contract, no matter how old that you are or gender or any of those types of things. So they're all protected. So there isn't an age necessarily with a first-time home buyer. They're obviously more common the younger you are, because you haven't had a chance to be able to buy a house yet. But no, there's not an age requirement with the first-time home buyer. Boy, there's a lot of what mistakes should you avoid. What is the best way to raise your credit score? Great question. So some of it depends on what's already on the credit. So it's that famous saying, you have to have credit to get credit. So if you have zero credit, there's ways we can help you build your credit file. And one of the best ways to do that is revolving accounts. A revolving account is like a Visa, MasterCard, a gas card, overdraft, anything that kind of has a revolving feature, meaning that once you make the payment or pay it off, you can re-borrow that money again. It's kind of revolving in the sense that you have a limit and a balance, and you kind of have to stay within that tolerance. So if you don't have a credit card, you're missing out on a big part of what factors into your credit score. So that's one of the great tips, is to make sure you do have a credit card. Now, if you already have a credit card, what you want to do is keep it under 50% of its limit. If you can get it under 30%, that gives you the biggest boost to your credit score. So let's say it's a $1,000 credit card. The limit's $1,000. You want to keep the balance under $300 if possible, but not zero. So you want to just keep $50, $100. That way you're not paying a lot of interest, but you're keeping that balance under $300. Now, I have people tell me all the time, well, use it, pay it off. I get all the bonuses, rewards, points, all that type of thing. And that's great. They can be great financial tools, but they can have some traps built into that as well. But the goal is to pay it off before the billing cycle, because the credit bureaus only see it typically once a month. So whatever's on your statement is what they reported for last month. So then you pay it down to zero or pay it down and slowly use it through the month. If it's back up to maxed out or over that 30% on the next billing cycle, that's what they reported. They don't see it every second of every day. They don't watch every single purchase you make. It's only reported typically once a month. So what you want to do is either in your mind say, okay, it's not a $1,000 limit, it's a $300 limit, and always stay under that amount. That's where you're going to see the biggest jump to your credit score. And that's spread out over all of your revolving accounts. So if you have 3 or 4 credit cards, it's kind of over all of it. So all of your balance to limit ratios is what factors into the credit score. So that's one of the other tips. You don't want to like target one credit card. Let's say you have 3 and you start really targeting to pay one off and you get it all the way down to 0. Well, now that balance to limit's kind of spread out on the other 2 cards. So what you're better off to do is pay them all down under 50%, then start tackling one or the other. Whatever has been open for the least amount of time or has the worst interest rate, those are the ones you want to get rid of after that. But a lot of times people will target, they'll have 3 or 4, they'll target the small one or the highest interest rate, pay it off, close it, and they see their scores go down. It's because that balance to limit ratio on the revolving accounts. So you want to do it a little bit more across the board until they're all under that threshold, then start targeting the single ones. That'll give you the best boost to the score without kind of going backwards. Now, getting rid of them is good financial sense, paying interest. There's lots of reasons for budget to do it. But if you're trying to work on your score, there's more of a strategic way to do it where you don't go backwards while you're trying to improve your ceiling. And this is where collection accounts and charge-offs and things like this can really help your score as well. But the trick is to use the ones that are actively reporting. For instance, let's say you have a medical collection or some sort of collection on a cell phone that you turned in or whatever it might be, and it hasn't reported for a year. You're better off looking at the things that have reported more recently because they're actively reporting each month. What you'll see is if you pay off an old collection, it turns into a new paid collection. It looks like it updates the time frame on it, which actually can make your credit score go backwards a little bit. Now, it's hitting kind of a ceiling because of that collection account, but you don't want to raise the ceiling while temporarily going backwards. So that's part of my job is to look at the credit and say, okay, why or where can we improve these scores? Like, why is the score the way it is? So then we can strategically say, okay, go do X, Y, and Z first. So that way you're moving your score up as you're getting rid of some of the problems with the credit file. But the number one tip, revolving accounts. It's a huge factor in your credit score, and how you manage that can be faster because it's every month that reports. It can be much, much faster to improve your credit score with revolving accounts than almost anything else. But there is kind of a ceiling it's hitting if there is old collections and things like that. But I can't tell you how many people, they've just buried their head in the sand until they're ready for a mortgage. Now they have to go back and try to clean all this stuff up, and they go backwards because they start just thinking, okay, I'm going to pay this one, I'm going to pay this one, I'm going to do that. They actually go backwards before they can really start going forward. So if you're in that situation, I'd love to help you. Even if you're not ready to buy a house now, maybe this year, next year, down the road, I really don't mind helping you to get on track with credit because it ties into mortgages, it ties into cars, insurance, even employment can look at that credit profile. So the more you improve it, the more it's going to help your financial future. You'll just pay less interest over time if you spend the time getting the credit scores up a little bit and not just do it shotgun or just guessing. Make sure you have somebody review the best ways to work on that credit profile. All right, let's see if we got some more questions on here. And if you have any questions, I'm not sure how it looks on the screen, but I think you should be able to post a question. I should be able to see it. So if you do want to post a question, you can there on the stream. And I do appreciate anybody that's watching, and let me know if you're here. You can say hi on the chat, and I just want to make sure it's working. Because this is a new system I'm using. It's called StreamYard, which allows me to kind of do one video but then post it a couple different places. It's what I've been using for another channel as well, and it seems like it's working really well, but I don't know. We'll see. After I get done with this and post it, maybe it'll just show me that you can't even hear me, but my button's on, the light's on, so hopefully you're hearing me. All right, let's see. What kind of mortgage should I get if I'm a first-time home buyer? It's whichever ones you qualify for. The first-time home buyer gives you some different guidelines, but it doesn't really change the type of mortgage you get. The ones that are most common is you're going to hear this abbreviation called FHA. That's a very common one because it allows 3.5% down. You can do a small second or down payment assistance to pay for that 3.5% down. So that's one of the most common ones because it does have some guidelines that are a little bit looser with job history, credit scores, things like that that really help the first-time home buyer. But it isn't like there's a loan that only first-time home buyers get versus anybody else. There's just kind of designation that helps with that particular guideline. But I'd say FHA is one of the most common for first-time home buyers because of that down payment requirement, credit score leniency, job history leniency. There's a few things that really trigger with FHA for first-time homebuyer needs. But there's also conventional loans that only require 3% down. So if you have a higher credit score with the down payment, that's where these other Home Ready is what it's called, or Home Possible with Fannie and Freddie have some pretty compelling guidelines for people that only had FHA as an option before. So that's been some pretty exciting changes if you have a higher credit score. It's not as good because the mortgage insurance is more expensive on conventional if you're under a 680 credit score. But if you have the credit score and have the down payment, that's where conventional can be a little better option. Some of these programs also have income limits. So you can't make over a certain amount of the median income for a particular area to qualify for some of these specialized programs. Let's see what else we got. Do first-time homebuyers need to put money down? They don't. There is 100% financing options available through either USDA. FHA does have some options. Here in Utah, we have a great program called Utah Housing that's an FHA loan. There's it used to be called Rosebud. Now it's called some other programs that are SBA or DPAs or down payment assistant programs. So there is a lot of those that don't require money down. But if you are putting money down, the lowest down payment requirement's 3%. So I have people say, yeah, I've got some money to put down, thinking like a car loan or something like that. You only got $2,000, $3,000, $5,000. Then it usually doesn't even come close to the 3% down. That's the minimum. FHA is 3.5%. I know it's weird to be 3.5%, but it's always been that way. Then the next tier is 5%. Then after that, there really isn't any tiers in between 5% increments. So once you're at 5%, there's not like 7%, 8%, 9%. It kind of goes from 5 to 10, 15, 20, 25, 30, that kind of thing after you pass that certain tier. Now, one thing to mention when it comes to down payment, that's the down payment for the sales price of the property, plus you're going to have closing costs associated with obtaining the loan. This is to cover title fees, your year of homeowner's insurance, you're going to have origination charges, appraisal fee, recording fees. Those types of things are on top of your down payment. Now, I have people say, well, I'm just going to roll it into loan. You really don't roll it into the loan, you roll it into the sales price. So for instance, let's say it's a $300,000 home, you would offer $310,000 to get the $10,000 back to cover all those other costs. That's the best way to quote unquote roll it into the loan. There really is no way to go above the loan amount. The loan amount's set on the sales price or appraised value, whichever's less. And then the down payment is off of that number, then closing costs are added on top of that. But the best way to do that is roll it into the sales price. So I often tell my clients, instead of negotiating maybe on the price, keep the price more where it's at, just get more for it. Include maybe repairs on the home or cosmetic things that you're looking at or features that you want to stay within the home. Maybe there's some sort of something you want to stay with it. Just include that in the price, but roll the fees into the price. That is by far the best way to do it. I can show you the math on it. I can, if you don't think that's true, I'd love to prove it to you. That's better than building it into rate. It's better than bringing the money to the closing table. It's just better to just roll it in as part of your offer on the price. So if you don't, though, then that is down payment plus those fees that you'll have to bring to closing. And they run anywhere between 1% on the low end to 3% on the higher end, depending, again, on type of loan. I mean, there's lots of factors when it comes to loan amount sizes and credit scores and all those types of things. But it is going to be on top of any down payment that you have. So building it into price is one of the best ways to do it. Regardless if you're doing 100% financing or 20% down, it makes sense to roll it into the actual price of the home. All right, let's see how we're doing on time. I think we're doing okay. When should I buy a home? As soon as possible. As soon as you can. I mean, I really believe that. I don't think there's been too many people. There's been moments. I mean, the 2008 financial crisis, which just seems like a lifetime ago, is probably one of the worst times. And even then, it recovered in many, many areas very, very quickly. Depends on the area. I mean, real estate's local. What's happening in downtown Detroit, downtown Barefoot, Idaho, downtown Seattle versus here, it's going to be different. Real estate's going to be local. But if you can get into a home, there's very few times where I've ever had somebody say, "Well, I really wish I didn't buy that house," because you still have a housing expense. Even if you end up selling it for no real profit, you're still going to have the tax benefit while you're doing it. There's still going to be appreciation in most markets. You still have a housing expense anyway. You might as well own it. So I think that people wait too long to try to time the market, wait for a crash, wait for interest rates. If the home fits and your budget fits, I don't think you'll regret it. You can turn it into a rental. You'll be able to sell it for something else. So much net worth of people is based on home ownership. Like it's 70 times, or not 70 times, like 7 times, 8 times more than somebody that rents is their net worth because of home ownership. There's just the tax benefits, the housing expense you already have, and the appreciation factor. It's well worth trying to get in a home as soon as you can. I really don't think you're going to regret it. I mean, if there's somebody who regrets it, it's 1 out of 1,000. You know what I mean? Unless they just bought. I mean, there's still some mistakes that get made. People buy at the wrong price, or the home's a lemon and needs a lot of repairs. I mean, there's still going to be risk in real estate, but it's far less than anything else out there, like crypto, gold, stocks, bonds. I mean, and the fact that you still have a housing expense. So owning it is way better. And where else can you get 100% financing or 96%, 97% financing on what you're trying to buy? So the ability to get the loans, the term of the loans, the interest rates locked in, the tax benefits, the appreciation factor, it's just win, win, win. And the longer you keep the home, the more that homeowners win in the long run. They just win over renters all the time. Because I look at this, what did you get for your rent for the last year? Just the chance to live there, right? And of all the people out there that are renting, how many people have seen their rent go down? You're lucky in most cases that the rent stays the same. Usually it goes up on the renewal or the next renewal. And some of that has to do with the cost of living. Some of it has to do with the cost of the property. Some of it has to do with interest rates going up. So landlords have had to raise their prices on that as well as they've sold property to the new prices so they can cash flow on these properties. So there's always going to be, especially now over the next few years, more pressure to raise rents than to lower them. Now, there's exceptions. Sure, there might be people that just have their rent stay the same, which is a blessing, versus having it go up. But it is something where you'll have much more of a consistent locked-in payment on a home than you will on any rental. And what are you paying in interest on a rental? Like 107% when you factor in you're losing the benefits of appreciation, you're losing some of the tax benefits, and none of it's going to anything but the chance to live in the house for the next 30 days. So I just think that people wait a little bit too long. And there's nervousness, scaredness, fear out in the marketplace. I totally get it. And that's where part of my job is to find out what you qualify for, help you to qualify for the best, and just make sure that we find the right home that fits the budget. So that's part of my job as well. All right, how are we doing on time? Any questions can be posted on the stream. I'm sure that this works, right? I'm not sure, but if you're there, if you can post and do a question, that'd be great. Let's see what else we got here. Are there things to look for in a realtor for a first-time home buyer? That's a good question. I would say there's ones that advertise kind of that they help first-time home buyers. I would say a lot of times if you have an agent that's more seasoned, they may have like a buyer's agent that just focuses just on that, and they might have a team or something like that. Usually people that are newer in the business are working with also people newer to buy homes because they're a little more hungry, I guess, kind of getting their feet wet, also kind of learn the process. So newer agents seem to gravitate also towards newer buyers because they're just breaking in the market. And so that's some of the things I would look for, but I also would check their license, check their references. That's where I can help as well, is I've dealt with a lot of agents here in town. I can give you a good referral on what agents are good. Some of them will target certain areas. They just maybe target a certain part of town or a certain area, and that I can kind of help narrow it down a little bit of who services a certain part of the county or the state that can help as well. So, but just like you would anything, like the loan officer, check their license, check references. I mean, those types of things before you commit to signing those documents. And always just read things, slow down, read through what you're signing, sleep on it. We're still in sales and people want you to sign all the kind of stuff, but take the documents and sleep on it if you need to, or ask some questions, or bring it to a loan officer, talk to a title company. Title companies deal with agents on both ends all over the place. They are some great resources for references, if nothing else, to tell you who maybe not to use as much, or who's more of a problem on the back end, and who is not a problem solver. And And I think title companies are great. Like when I'm looking for referrals, I'm usually calling title companies in other states because of that relationship. They get to see the front end of the loan, the back end, the signing, the loan officers. They get to see a little behind the scenes more than any other part of our industry because they're dealing with buyer's agents, seller's agents, mortgage officers, front and back, all of this type of stuff. They can give you kind of a good feel of who's a good agent. Are housing auctions accessible for first-time home buyers? Yeah. Generally, though, you have to have more money at the bidding process. Now, if you're trying to buy a HUD home, so FHA, VA, USDA, if they foreclose on a property and it goes to a certain stage, it goes into what they call their REO, or Schedule of Real Estate, and then they usually handle the auctions themselves through the HUD's website. Very rare in our area that they even pop up because they usually get sold or investors buy them, that type of thing. But if it gets to that stage, the first 2 weeks of that listing only can go to buyers that are going to live in the property before it can be bidded out to investors. Now, the problem you're going to have with auctions too, though, is usually the homes aren't in livable situation. Maybe they've been distressed or they haven't been taken care of. They've gone through a long foreclosure process. So the yard usually is not in good shape. Maybe there's some deferred maintenance. There's some problems with it. But as a first-time home buyer or an owner of the home or living in the home as a primary residence, you get the first crack at those particular homes before they're opened up to just the general population or investors, that type of thing. So it's very rare that we see them here in southern Utah. They just don't get to that stage before they get bought or short sold or something like that well before that stage. But you can. It doesn't matter if you're a first-time home buyer, it doesn't limit your ability. But auctions, other than the HUD auctions, will usually require a larger kind of down payment, and then you usually have to have the rest of the money in a very short window. So usually the auctions don't let you get 30 days to close on the loan. So you either have to have private money, you have to have mom and dad kind of help pay for it and then refinance it and get their name off of it. So you just have to have access to most of the sales price very quickly. Like if you get your offer accepted, it's anywhere between 48, 72 hours to have the rest of the money of the winning bid. And most first-time home buyers don't have that much money ready to go that quickly. They need the time to put together a normal loan. But if you have somebody that can pay cash, a family member, something like that, and then you just refinance it into your name, there is options to make that work. So that's important aspects of it. Now, there's all kinds of rabbit holes when it comes to that. So if you are looking at doing that, please call me or talk to a loan officer because there's seasoning requirements. There's all kinds of different things to pay off your investor or a family member to get their money back. And so you want to make sure you get it structured correctly. Otherwise, they won't be able to get all of it back and they'll have to leave it. And so there's just right and wrong ways to do anything. So that would be one. But it's not like when you go to the auction, you have to say, raise your hand. Who were the first time home buyers? You have to raise your hand, or something like that. So it doesn't matter what type of buyer you are for that, but the ability to actually win the bid and then get the cash to the auctioneer, that's usually where you're going to run into a bigger problem when it comes to the funding. Do first-time home buyers have to pay mortgage insurance? Mortgage insurance is regardless of first-time home buyer. It has to do with the loan to value, which is where you get that 20% rule. So if you don't put 20% down, you have to have this additional insurance that protects the lender that if you default and they go to auction the home, if they have to lower the price, if it takes longer to sell, if their loan balance keeps going up, the insurance kicks in if the lender loses any money on that investment, and they get that money back. So it's not a first-time home buyer thing as much as a down payment thing. So if you only put the 3 or 3.5% down, then you have to have that mortgage insurance. One caveat with that is FHA requires mortgage insurance no matter what. So if you have 20, 30, 40% down, you still have to have mortgage insurance. So generally, if you have that money down, you look at the other type of financing options. Or instead of putting the money down, maybe we look at savings, we look at paying off other debts. We look at those types of things before just putting it all towards the mortgage. But mortgage insurance is really based on down payment, not necessarily first-time home buyer, upgrade borrowers. Any of those factors don't really factor into whether you need mortgage insurance or not. It's purely based on your down payment. What is the interest rate for a first-time home buyer? So there really isn't a big change with that because it's just one of the risk factors that goes into it. And I get that question all the time, is like, what is the interest rate? Excuse me. And there isn't just an interest rate, because There's pluses and minuses based on the type of loan you're getting, the property occupancy, credit score, down payment, debt ratio. There's all these factors of risk that go into determining your interest rate. It's just like saying, very similar to like life insurance or insurances. It's like, okay, what's the insurance rate? Well, it depends on what are we insuring? What is the credit scores? What is it, a property, a car? So there's a lot of factors that determine the rate that is for you. So it isn't just a rate that is the rate. It isn't something that's the rate. There's pluses and minuses, or what we call adjustments or hits to the rate that either adds or takes away from the risk of that loan. And what you'll see commonly on billboards and radio ads and anything that advertise an interest rate is usually one of the lowest rates they can offer. But if you look at the small print, it's like, well, to get that rate, I have to have a 780 credit score, been on the job for 10 years, under 60% loan to value, no other debt, debt ratio at 20%. I mean, it just 5% of the population can qualify for that. So it is something where the risk factors are very different. The risk factors will determine that interest rate more than just the rate that you're going to get. So to get a quote, you want to get a lot of those things figured out. That's really what's going to make the biggest difference. Well, I just noticed that, oh, hey, I can change stuff. That's cool. Oh, I got my... Oh, look at that. Had the other tag on the bottom. That's my other channel. So there you go. All right. Let's see. Okay. We're going to save. There we go. Okay. We got that changed out. Okay. Any comments? Let me know if they have any questions for when it comes to mortgages. That's what we're here for, to answer any questions about mortgages. I've been kind of focusing a little more on first-time home buyers today, but we can talk about anything you want to talk about when it comes to real estate financing. What was your worst experience as a first-time home buyer? Well, that'd be an interesting question, because it's funny. I was doing loans before I even bought my first house. So I did my first loan in 1999, and I remember going to the closing, and I had graduated high school in 97. And I remember going into my first closing, and it was an older couple, and we're signing documents and signing papers, and they're kind of just looking at me kind of weird the whole time. They're just signing stuff. And finally, the lady said, "How old are you?" Oh, that's a fun memory. And I'm like, I don't remember if I answered. It was just like, I think I did answer. I think I just told them my age. And it was just kind of funny that first, especially even my first 5 years in the business, I've always had a little bit more of a baby face, I guess. I don't know. I've always, especially younger, I just looked a lot younger than I felt. That's for sure. I got carded, for anything, anywhere. I don't drink alcohol or anything like that, but anywhere I went, need a driver's license or whatever, I had to show it for everything, because I always had kind of a younger look. And so, but it was funny. When did I buy my first home in relation to how long I've been in the industry? So I never really felt like I was a first-time home buyer, because I've been through the process so many times that I never really had that feeling of what it was like to be a first-time home buyer. I mean, I've been doing this since 1999, so we're coming up on 26 years of doing loans, and so I've seen and done it all, and it's such a fun industry because there's so many problem-solving aspects with the industry that we have all these man-made boxes, guidelines, interest rates, mortgage insurance, title insurance, all this stuff that has to kind of come together to make a loan work, and not everybody fits perfectly in these boxes. So we've come up with guidelines to say, well, what happens in this case or that case, or and that's the fun part of the job, is to also tell the client kind of, okay, this is the reason we need a certain document or a guideline or something like that. And knowing the why makes it funner, because then you can get the what a lot easier. And that just makes it fun, is just figuring out when a client walks in the door, how can I help them get into a home loan? I know some loan officers just gravitate towards cookie cutter, pushing the same kind of paper. And I like to work on loans. I like to help people with their credit. I find it pretty fun to have somebody come in my door, and then 6 months later we get them into a home loan because they went off and fixed their credit and got their down payment where they needed to, or whatever we needed to get them qualified. That's pretty rewarding. The sad thing is when you give them all the advice and they just disappear forever, then they call you a year later and say, hey, I'm ready to buy a house now, and they haven't done anything. They haven't done anything to help their situation. So it's like, okay, well, the advice I gave you a year ago is still probably pretty similar to what I'm going to give you now. Let's start working on some of this stuff. But we are just a microwave society. When people finally get their leases about to expire, they're ready to finally buy, then they want to buy right now. And if they don't hear they can, then they just put it on the back burner and just forget about it. That's, I mean, that's human nature, just kind of the way our society is. But if you're thinking about buying a house, whether it's this year, next year, there's things you can do or start doing now to get yourself a better loan when it's time to do it. And that's part of doing the pre-approval. And it doesn't cost anything. Calling me doesn't cost you money to pull a credit report, to do any of that stuff. So I just want to show you the different programs you qualify for today, or go do A, B, and C, and you'll qualify for more down the road. But I think there's so many more positive reasons to buy a house than to not. Even in the market, finding it's probably the harder part right now, absolutely. But if you're ready to go and a home pops on the market, you can be one of the best offers on that house. And that's what I'm seeing way too many people are talking about. Oh, I'm waiting for interest rates. I'm waiting for a crash. I'm waiting for this type of thing. Well, if you have 100 buyers waiting for that to happen and one of those things does happen, now all of a sudden you got the prices going up because now you have way more buyers with the same amount of inventory. And especially in the low range. I have all these people that are waiting to buy that are in the lowest possible price range, which will always have the most competition. So that's why we don't see a lot of movement in price crashes in the lower end. Now, the higher end, sure, $800,000, $900 million homes, there's only a certain number of buyers that qualify anyway. If that buyer pool goes down, that's where you see those prices have to go down to sell. But not in the 3 and 4 in our area, the 300,000, 400,000. That's less than the median home price, which means there's way more homes, less homes in that price range than above that price range. And there's just more buyers that can qualify based on the income and the jobs of the area. So it's more about finding the home that works than it is trying to time the market just perfectly, because you'll miss out on that home in that location or that price or whatever it might be. And if interest rates do get better, you can always refi. It's not like you're locked into that rate absolutely forever. You're only kind of locked in as you first purchase the house. But you can lock in the price, what you paid for it, which will be lower now than it will be a year from now, 2 years from now, 3 years from now. So I don't think waiting is the best option, especially when so many other people are waiting. All of a sudden, a bunch of people enter the market. Either that home goes or goes for more because out of the 100 people that are more qualified, they can submit a higher offer and then they end up winning the bid on the house. So being ready for the market, I think, is more important than finding a house and then trying to get ready. Does that make sense? I mean, you're better off to get ready now and then be ready when the home actually hits the market. How are we doing on time? Let's stick around a little bit longer. Any questions can be posted there. Let me see if they get posted. I don't know if I hope this is working because this is kind of new on this little StreamYard thing that I'm using. So hopefully we are live. I don't know. I guess we'll find out later. Okay, let's see what else we got. Is a first-time home buyer program really helpful? Absolutely. It is for the people that need that program. Just like a reverse mortgage, really helpful for the people that need that type of mortgage. I mean, that's what the market's trying to do with these programs, is fit a need within the marketplace. And when you need it, it's the best loan out there. But if you don't need it, then it doesn't really matter. You know, that designation, I've had people that they're classified as a first-time home buyer, but they don't get any of the benefit from that program. It just opens up some more programs you wouldn't have had access to if you didn't have a first-time home buyer designation. But it really is designed to fit a need within the market. And if that need is what you need, then there it is for you. So that's really, yes, it's a fantastic loan for just like any other loan, but they have pluses and minuses. They have benefits and disadvantages. So knowing why or the programs you qualify for is just as important as having just no options to choose from. What should first-time home buyers know about fixer-uppers? Depends on how much of renovation that it needs, because if it needs too many repairs, you're not going to get the loan. If the loan's already a higher percentage of loan to value, you're only putting minimum down, they don't want to have the financing on a home that needs a bunch of work and repairs, especially if you don't have the money to actually do those repairs. So it's harder for first-time home buyers to do fix and flips, or not fix and flip, but fixer-uppers, depending on what needs to be fixed up. Now, if it's just cosmetic, carpet, paint, landscaping, that type of stuff, it's usually not as big a deal. But if it's something where it's like electrical, roof, plumbing, cabinets are falling off the walls or just stuff like that, that's when you're going to need a different type of loan, either a 203K loan, or you'll need to do private money or do investor or some other type of money to get it to a kind of a sellable or livable standard and then roll it into more of a permanent loan. So those are really exciting loans to be able to help people renovate homes. You usually don't see first-time home buyers in that category because of limitations of down payment or type of loan programs that qualify for a home that is distressed. Again, rehab, remodel, cosmetic, that's fine. But if you get into stuff where there's major renovation, then that's going to be a different type of loan. What steps should a first-time home buyer take to secure a mortgage loan? First step, get pre-approved. Talk to a mortgage lender. The mortgage lender is going to tell you what documentation you need to gather up, what your price range is going to be, what your payment's going to be, what your down payment's going to be. It's going to answer so many questions by starting with the loan officer, not with the real estate agent. And if the real estate agent's running around taking you looking at homes, how do you even know what the payment's going to be? How do you know what if you qualify? Why would you go out and look at houses when you don't even know what your payment's going to be on it, if you even want that payment or even qualify for that payment? So start with the loan. You can go to my website at ryanbolton.com. There's a great mortgage calculator on there that you can use for free. You don't have to put in your email or sign up. It's just right on the main page there. It really gives you a chance to be able to just play with some numbers on what your payment's going to be. Now, what factors into a mortgage payment? You've got the principal and interest on the loan itself. So just like a car loan or any other loan, that's the minimum payment on the loan. But with mortgages, you add 3 other things to your payment. Number 1 is property taxes. Here in Utah, the taxes are due every November, so once a year, right around the holidays. So instead of having to come up with $1,200 at the end of the year, we divide the yearly amount by 12 and just add that to your payment. So if it's $1,200, that's $100 more per month. And most property taxes are probably going to be more than that. So you're going to have to add $100 to the principal and interest. Next is the homeowner's insurance. Homeowner's insurance has had a lot of changes over the last few years as fires and floods and earthquakes have raised the cost of homeowner's insurance. And so that is, again, a yearly charge. Let's say it's $1,200 again for the yearly charge on the homeowner's insurance. That's another $100 that we add to your monthly payment. And then lastly is mortgage insurance. If you're not putting enough money down, you have to add that additional insurance, which is a percentage of the loan, so it can change what that monthly amount is. But it can be anywhere between $100 to $300 for that extra mortgage insurance. So you have the principal and interest on the loan, you have the property taxes, the homeowner's insurance, and then possibly mortgage insurance. One other thing you'll have to factor in is, depending on the home, it might also have an HOA or homeowners association. This will cover maybe a common area like a pool, a tennis court, basketball courts, and usually it'll cover front yard landscaping or water bill or certain other bills will be part of that HOA fee. So it can reduce maybe the insurance cost a little bit, maybe the property taxes a little bit, depending on the property it is, but you want to make sure that's factored in as well. So you could have up to 4 other things that you have to add to just the loan itself that you want to factor in. So if you say, well, I can afford $2,500 a month, you've got to back off the taxes, insurance, mortgage insurance, HOA from that number, then determine how much the mortgage can actually be for. Again, that's where a loan officer can help you see what you qualify for, or if you've found homes in your price range or you know a dollar amount you can afford each month, they can tell you what your payment's going to be or tell you how much your payment will afford. So again, if it's only $2,500, that's different if you have money down. If it's in an HOA, taxes and insurance will all affect how much home you can buy for $2,500 a month. So start with your loan officer. Start with me. I can love to help you in Utah and Nevada. I can help you in other states. I can direct you to other places. But that's really where I focus most of my lending is Utah and Nevada. And I'd love to run these numbers for you. It doesn't cost anything. I can run a very specific approval for you so you know what to shop for. And most agents and most sellers are going to want a letter from us, lenders, that say you've done that step. You've done the pre-approval. You've pulled your credit. You've checked your income. You are able to qualify for this loan. And the main reason for that is, let's say you're selling a house and you put the house on the market and somebody says, I want to buy it. It's going to take me 30 days to get appraisal, home inspection, close the loan. Okay, great. Well, now you can't sell that home to anybody else until after those 30 days. So now if it doesn't get sold, you have to put it back on the market and you have all this extra time on it. So you want to make sure that before you accept that offer that you are making sure the person's actually qualified for a loan. Now stuff happens. People lose their job. Something pops up on credit. Stuff can happen. But that first step at least allows enough confidence to take the next steps of appraisal, home inspection, things like that. One quick note too, on the home inspection, you want to do that before the home appraisal. These are 2 different things. The home inspector will spend anywhere between probably 3 hours on the low end to 6 hours on the high end, depending on the size of the home and that type of thing. And their job is to go through and check everything. Check every plug, outlet, switch covers, roof, attic, crawl space, whatever it might be. They'll find something wrong. I guarantee you. I don't think I've seen a single home inspection that didn't have something wrong. Now, it could be cosmetic or a little quick fix, or it may not be a deal killer, but there will be some. I don't care if it's brand new or 1,000 years old. There's going to be something wrong with the house. Stuff wears out, switches don't work, plugs don't have enough voltage. Stuff's going to happen. Or attic doesn't have enough insulation. Or what you see here in southern Utah a lot is the weather stripping gets worn out really quickly with the heat. That wears out. Or there's the little the termite or pest guards underneath the doors. They just are rubberized. So after a couple of years of 100-degree weather, those can just crack and get brittle. You have the little vent covers on the top of the roofs that have maybe the vent stacks and stuff like that. That little rubber bushing can go bad, which can allow water in, that type of stuff. I mean, nothing big. I mean, little bushings and stuff like that, a little rubber or weather stripping. It's not that big a deal. But sometimes there can be major stuff like electrical or plumbing or foundation or roof or appliances. They'll check every appliance, see what the model, the make, how old it is, if it's at the end of its lifespan. I mean, all kinds of stuff. But the home inspection is going to go through and they're going to find something wrong. And they're going to give you a list of what needs to be fixed or what can be addressed. And either you just know that going into it and say, okay, I'll just take care of that as a new owner, or you go back to the owner and say, hey, I want a few of these things fixed or reduce the price, and you can reopen the negotiation if they find something wrong. So home inspection's separate, and you want to do that early on to make sure it is the home you actually want to buy. The next is home appraisal. This is for your loan itself to make sure what you're paying for the home is what it's actually worth. So two things there. If it is worth way more than what you're paying for, that doesn't mean you can put less money down. The loan's going to go off appraised value or sales price, whichever is less. So, for instance, let's say you're buying it for $300,000 but only appraises at $250,000. That means you have to bring in that $50,000 on top of your regular down payment. Now, in most cases, that means you're going to renegotiate the price or you're just not going to buy the house if it's that much of a difference. But if it's the reverse, let's say you're buying it for $250,000 and it's worth $300,000, you don't get to do the loan for the difference. You're still going off the lesser of the two. Also, you don't order the appraisal when you're doing a loan. We have to make sure as lenders that there's no bias or anything that's happening with the appraisal. Now, this is more industry standard now. The rule for it has actually expired. But now that we've done it for so long as an industry practice since 2008, we order the appraisals through a management company who then randomly assigns it to an appraiser who then goes out and does the inspection. Like I would say 99 times out of 100, I don't even know who the appraiser is. And the only reason I know who the appraiser is maybe they got a phone call, the seller got a phone call, they call me or something and say, hey, this guy called me and was asking about the appraisal, and they might tell me his name. But very, very rarely do I even know who the appraiser is. And I cannot have any communication with the appraiser until after the report's in my office. And that's just to protect investors, lenders. It's designed to protect the public, sellers and buyers, that we're not coercing or having any communication with the appraiser to tell them basically, like we got to get this number, we got to hit a certain sales price, or we have to have it appraised at this amount. There was a lot of that going on during the crisis that really has worked its way just kind of out of the system. But that management company did add a fee, so they get a little bit of fee for this to be able to kind of manage the appraisal process. But it does give a little more confidence that there's no coercion going on between lenders and appraisers. But it's funny, I don't even talk to my appraisers all that often. We used to go to lunch more often, go to golf, just hang out, we're just part of being in the business. And now you just rarely even talk to them because it's something where they really deal with the management company more than they deal with us. So that's one little tip there. You don't worry about having to order the appraisal. That's something that we'll take care of as part of the process. But you do want to do the home inspection first, because if you find out you don't want the house anymore, you don't want to also pay for an appraisal you're not going to use. So that's kind of part of that due diligence, is do the appraisal first. All right, how else are we doing on time? If you have any questions, you can submit. I'm using a system called StreamYard. So hopefully, I don't know, it should post to, because I'm sharing this on Facebook and YouTube. This is a new system I'm using. So hopefully if you post to either one, it should show up. But love your comments, your questions. Jump on in there and I can answer those for you. And we'll just kind of keep going here. I'm looking to invest in real estate, and I'm also a first-time home buyer. Great job. What would you recommend the best approach for this? Well, most times what you have to do is end up buying kind of the home you can qualify and afford now. Then usually you have to keep it at least 6 months to a year. Then you can turn that into a rental and then go buy another house again. So that's usually the best way for first-time home buyers to kind of get into the real estate world, is to start kind of building it up over time. Or you have to put enough money down to where you can buy the home as an investment property. So usually first-time home buyers, one of the biggest reasons you're a first-time home buyer is you don't have enough money down. And so you have to use these programs that have limited down payments. But limited down payments are only available if it's a primary residence. You're not going to see 100% financing on an investment property or a vacation home or a VRBO or something like this. So whenever it's a rental property, you have to put anywhere between 15% on the very minimum down up to about 25% is more common. And so you have to just have a lot more money down to do the real estate investing. But if you own the home as a primary residence, you can keep that primary residence loan and turn it into a rental and then go buy another primary residence. So and then that one, maybe over a year, you turn that one into a rental. Now all of a sudden you have kind of 3 homes, but it takes some time to build it up that way unless you're able to come up with enough money for the down payment. So that's how I got started. My first 3 homes I owned, I kept and turned into rentals, and then eventually ended up selling them. We moved down to southern Utah and sold a couple of them. I still have a couple homes now that I once lived in, and now they're rental properties. So, and there's a mindset with that as well of whether you want to be a landlord. There's differences when it comes to cash flowing and that type of thing. But I would also say usually the investors, that's the best way to cash flow, because over time the rents will go up, even though the mortgage payment won't, in what you can rent the home for. So it can be a slower process unless you have that money to work with. So if you get an inheritance or a trust or a living will, something that gives you kind of a lump sum to work with, there's a lot of ways you can do real estate investing. So if that's you, if you have something where you're getting money from a sold home or something or an inheritance and you want to get into real estate investing, I'd love to show you some of the ways you can do that, whether you own a home or not, or you're a first-time home buyer, so I can help you with that. But usually real estate investing, outside of kind of turning your primary into rentals and kind of building it up over time, it usually just comes down to money, having enough money for down payment, having enough money to cash flow. That's going to determine how much real estate you can own in that sense. So yeah, give me a call if you have any questions on being an investor and you've got some money to work with. We can show you ways to invest. What is the best website for first-time home buyers? Well, it depends on what kind of website you're looking for. Mine, self-promotion, RyanBolton.com. Let's see. Are there any first-time homebuyer programs available? Yes, there's a lot of first-time homebuyer programs available. One of the better ones here in Utah is FHA with a Utah housing loan. That's a really good loan to look at if you are a first-time homebuyer. What it is, it's an FHA loan for 96.5% of the sales price, so a big chunk of the sales price, and a second mortgage to cover the down payment and some of the closing costs. So it really is a good down payment assistance program. The nice thing, too, is that second mortgage, that you got the first FHA, the second is a 30-year fixed rate loan. So it's not a 10-year or a 15-year and interest only or something like that. So it's a pretty good second mortgage, and it's 1% above the first. So the rate for a 30-year fix, it's just a great rate. Like most of the down payment assistance programs out there do have some higher rates. Now, there is some down payment assistance programs that don't have repayment requirements if you keep the home, stuff like that. So that's worth looking into as well as kind of loans that just help people into first-time homebuyer positions. But they usually have income restriction, location restrictions. But that's part of my job, is to just sit down with each client and figure out the best way we can help them into a loan and which loans they qualify for. Do first-time homebuyers need a down payment? Not always, sometimes. So again, it depends on whether they qualify for the down payment assistance, the Utah housing loans, if they have mom and dad helping with gift money, that type of stuff. But no, you don't have to, but there's different programs that open up with the down payment. As a first-time home buyer, do you have to live in that house, or can I rent it right away? That's a good question. So when you get the loan, you are getting it as a first-time home buyer in most cases as a primary residence. So you can do a first-time home buyer loan on an investment property, second home, that type of stuff. But if you're saying it's your primary residence, then it has to be your primary residence. You cannot buy it and then turn it right into a rental and never live in the home. That's basically occupancy fraud. It's one of the number one frauds in our industry, is claiming primary residence to get the better rates and terms and not actually living in the home. Now, it doesn't mean you have to live in it forever. It doesn't mean you have to, but you do typically need to be at least 6 months is what I've seen, even up to 12 months. Is what they want to see. Now, you could rent out a room, you could rent out the basement, you could rent out rooms as long as you're still physically living there. But it is something where the intent to live in the home is how you got that loan. And if you never really do move into it, then that's an issue. Now, I have seen times, let's say you move into it and all of a sudden the job changes, something changes where you have to move out, or there is exceptions to that if there's really a life-changing event. The problem they don't want to see is that you never really intended to live in the home, that it never really was a primary residence. That's where they're going to run into suspicion. Now, how do they find that out? Let's say the utilities never go in your name, or they can do some drive-bys. They actually have lenders that will do inspections if they suspect any kind of fraud or any kind of issue. But one of the most common things they want to see is that your address starts to change to that address, like on the driver's license, or utility bills show up in your name. Those types of things they can kind of check. But if all of a sudden all that stuff just goes into somebody else's name, that could red flag. They could drive by. They can send an inspector out. They'll do that with like foreclosures too. They'll drive by and see the condition of the home, see who's living in the home. So they can do that if anything kind of flags the account. But that's the biggest thing. Now, you can rent out rooms. There's no problem that if you got roommates, friends, family that are going to rent from you, as long as you're also living there, that's not a problem. But if you don't ever live in it and you said it was a primary residence, that is mortgage fraud. You claimed it to be a primary residence only to get primary residence financing. So you do want to be really careful with that. If there are 2 purchases on a home and only one is a first-time home buyer, can first-time home buyer get first-time home buyer tax credit? I don't know about the tax credit for that. I don't think so. That's a good question, actually. I don't know no, because if it's a first-time home buyer, that's the only way you get that credit. But again, you only have to, if you haven't owned a home in the last 3 years, then you do get that credit. So it kind of depends on if you qualify for a first-time home buyer or not know you're a first-time home buyer. But I don't think so. So if you had, let's say you had a husband and wife or something, and one had never owned a home and the other one had, I don't think the person that isn't a first-time home buyer would not get that credit. So I'd say no, it's probably got to be only the first-time home buyer. Should first-time home buyers use Zillow, real estate agents, or another approach? Zillow is just a way to find the homes, but a lot of times there's still an agent that's involved with it, so there's still agents involved. But checking Zillow is fine, to just kind of see what's out there, what's in your price range, what's in the area. You can do a search for bedroom, bathroom count, garage count, acreage. I mean, there's all kinds of filters to be able to use on Zillow. So Zillow is just a website, but generally if you find a home, you'll see who's kind of listing that property. But I do recommend for first-time home buyers to get your own agent and not necessarily use the listing agent that's also representing the home, because their job is to represent the sellers. That's a completely different negotiation side of the transaction than the buyer's agent. So I do recommend that you get your own agent that's representing you in the transaction, and not the seller's agent who's representing the seller. Now, they can do both. There's dual all the time, but if push comes to shove, they represent the seller. So they're going to make sure that they give the seller all the information that they can to give them the best price on the home. So you really want your own agent. But again, loan officer first. Really, you want to talk with loan officer first, because you want to get that pre-approval letter. You want to get your ducks in a row. You want to make sure you're even shopping for the right price range, what your payment's going to be. You really, really want to start with your loan officer first. Now, you can talk to your agent. They should give you a good referral. I can get you a referral for a real estate agent as well. But you want to start with the loan, because that will determine price range, payment amount, so many factors before you start driving around town and either get discouraged or can't find anything, or just waste your time. You're not even ready to buy a house yet. So that really want to start with the loan first. Can you use first-time home buyer more than once? Yes, you're a first-time home buyer if you haven't owned in the last 3 years. So if you sold 3 years ago, now you're a first-time home buyer again. Then you buy a house, you sell it, you wait 3 years again, now you're a first-time home buyer again. But after you buy the home, you're done, because it is first time. And that's what's kind of deceiving. It's not the first time ever, because it is that 3 years. But it's not like you can buy a home right now, a year from now, be a first-time home buyer again, because now you're not qualified, because it's been within the 3 years. But yeah, you could use your first-time home buyer designation 10 times in your lifetime if every single time you have to wait 3 years from owning the house, because you get reclassified as a first-time home buyer. I don't know what other name we could come up with, because first time is like first time driving a car, first time going to a restaurant. It's first time, and there's not a second time. But really, you could be a first-time home buyer several times if there's been 3-year gaps between your home ownership. So, mortgage industry for you. What do you want me to say? That's just what it is. All right, let's see. Can first-time home buyers buy foreclosures? Yes. So the home's condition is going to matter more, because if it is in foreclosure and very distressed, it'll be very hard to get the financing on it. It needs to usually be rehabbed first before you can get more traditional financing. This is where you got to use private money or family and friends or something like that to at least get it purchased, renovate it, then roll it into a permanent loan. But There isn't something where we can say, okay, well, this is a foreclosure, or this is a condo, this is a townhome, this is this or this or that. So first-time home buyers don't qualify. It doesn't have a disqualification based on your age or first-time home buyer, or even the use of the home. Now, the type of loan you're going to get is going to change, but it wouldn't restrict you from being able to buy a foreclosure. But I would say the most common issue you're going to run into in foreclosures is usually they're more distressed. They either have been abandoned or they've been mistreated before they were foreclosed on. So generally, you're going to have more of a problem with getting the loan because of the condition of the home, not the type of loan that you're trying to get. Should first-time home buyers be wary of every realtor they come in contact with? Every? No. Some? Yes. There is some. Yes. But every? No. I mean, no. But, you know, that's part of getting with an agent you trust, getting referral sources, check with title companies. I mean, that really is a great referral source, checking with title companies, because they work the front end, the back end, behind the scenes with all the agents in town. They usually have a pretty good feel of who they can refer you to, or loan officers, like we deal with them all the time. And that's where I can kind of help you narrow down who you want to work with. But starting with a loan, I think, is going to be your best tip when it comes to that. Now, I'm biased, but even if I wasn't a loan officer, I'd say, okay, why would I want to go? You know, it's a little different than like car shopping, because cars, you can kind of go drive around and then you get into the finance department. But it's usually a slower step between a test drive into the finance company, where the finance side of things can be a lot more time consuming and a lot more moving parts on a mortgage. So you really want to start with that first, because it's free and you get an idea what you qualify for, and you get an idea what you should even be shopping for and what your payment's going to be. And so really start with a loan is the best way to start. See if there's any other questions submitted. I hope the question thing is working. Again, this is on StreamYard, and it says it's playing on my Facebook and my YouTube, so hopefully that's right. I have trouble with my nose itching. People are thinking about me because my nose is itching like crazy. No? Nobody? Oh, all right. Whatever. Should first-time homebuyers be wary of every realtor they come in contact with? Every? No. Some? Yes. What is the quickest way for a first-time home buyer to qualify for a home loan? Start with a loan officer, because that'll tell you what loans you qualify for and the documentation you're going to need. That's usually the biggest hang-up, is getting documentation, getting the application filled out as accurately as possible, and then finding the home that fits. That's usually the things that take the time, because either the price range you can qualify for is pretty low, so you have to kind of wait out the market and make sure you find one, or not getting your paperwork in time, not getting the application so we can issue the pre-approval. So the quickest way is to start with your loan officer, because that way you can get your ducks in a row. You can be ready to go. That way when the home hits the market, you can be the first or second one to submit an offer, and you'll be able to shorten your time frame. Like almost, you can talk to agents or talk to sellers. Very common to be 30-day closings, because it takes time to do the due diligence, home appraisal, inspections, that type of stuff, underwriting. Usually you're like a 30-day window, 30, 45-day window. And if you can shorten that, your offer is going to stand out, because one, the seller knows they're going to get their money sooner, so your offer stands out that much more, and they know you've got your ducks in a row, that your offer is stronger. It just is a great free way to make your offer stand out, is just have a shorter time frame to close, because you got all your paperwork ready to go, that you're ready to, or just have to do quick updates like the updated pay stub or something like that, but you got everything else ready to go. And so all you're waiting on is getting the title report, the home inspection, the appraisal, and you can close. I mean, that is the best way to make your offer stand out without submitting more earnest money or higher price or other contingencies. That's one of the best ways, is to be able to get that loan done, get the loan stuff done sooner. What are the best banks for first-time home buyers? Usually it's not so much banks that are going to offer better first-time home buyers, because maybe sometimes they don't have access to FHA or down payment assistance programs, things like that. So usually brokers, myself, mini correspondent lenders that kind of do that are going to be a little bit quicker and better than necessarily a credit union and bank. Not always. I think it depends on the loan officer, depends on the company, that type of thing. But I think we, as a percentage of the first-time home buyer loans that get done, I don't think banks, like traditional banks, do as many of them, because they're dealing with car loans and home equity lines of credit and move-up borrowers, and their current clientele is a little bit different than brokers and stuff like that just have way more of the down payment assistance programs, FHA, Utah Housing, some of these other programs. So I would think, I could be wrong there. Maybe that's a good thing to check. I think brokers probably do a little bit more for first-time home buyers as far as just access to more ways to get it done. So I think that's probably a big step there too. All right, nose. The nose. All right. Let's see if we've got anything else here. Let's just go to general mortgage for a little bit. What do you say? We are focusing on first-time home buyers, so if you're watching the video, if you want to have any questions about credit, first-time home buyer, any questions about co-signing, down payment assistance, I mean, all that fun stuff, I'm here to answer your questions. All right, let's see what we got here. What type of loan, conventional FHA, VA, has the lowest down payment and closing costs? Well, first off on down payment, conventional typically requires at least 3% down, more commonly 5%. FHA requires 3.5% down, and VA loans are 100% financing, one loan, one of the best loans on the planet, if not the best loan on the planet. But you have to be a veteran or have served in the armed forces to get the VA designation. Another one that's 100% financing is USDA. Yes, the ones that handle the beef. The Utah Department of Agriculture does have a home loan for certain designated areas. So they have underserved areas that have lower populations that do have this loan program called USDA rural housing. The downside with it is it's very strict on its debt ratios, so it doesn't have a lot of leniency on debt ratio. Hopefully they'll maybe expand that a little bit, but that's one of the biggest problems I see with that, and it's very specific to an area. So it's not like the entire county can qualify. You can go to USDA property eligibility. You can put in an address. You can kind of put in a city. It'll show you where eligible areas are for this particular program. But I have found the debt ratio is pretty strict on USDA, which means that their buying power is less than an FHA loan with down payment assistance programs, things like that. So because of that combination of limited on where the property is located and the strictness of the debt ratio, we're not doing nearly as many of those as we used to. I remember like pre-08 and even a little after, those were pretty popular loans in our area, but also just the cost of the housing and the debt ratios, that side of things have really kicked people out of USDA for the last little bit. In fact, I haven't probably run a USDA quote now in probably a year, maybe more, because of that reason. It's so restrictive on that debt ratio. It just doesn't allow a lot of people to be able to purchase a home in our market because of the prices. Hopefully they'll expand that. I keep hearing they're going to be more of an FHA kind of underwriting with it. So hopefully we'll see a little bit more of a risk-based debt ratio assessment. Because if you think about it, if you have a debt ratio of 43%, you make $2,000 a month versus 43% you make $8,000 a month, the percentage is the same, but the money left over is a lot more dramatic. So I think that needs to be part of the factor, is kind of what's left over and not just that number itself. But at the same time, we don't want people out there with a 70% debt ratio either. That just leads them into being tied to the house or risk of foreclosure and having to go through all that. So there's a blend of making sure the debt ratio works. But that's where I think one of the bigger restrictions with USDA, outside of the location. Location's great. Serve those underserved areas. If it's restricted to area, that totally makes sense. But that debt ratio restriction really is holding people back from being able to use that loan program. So that's down payments. So you got 100% USDA VA, 3.5% FHA. Conventional does have a 3% option, but more commonly is 5%. And then when it comes to closing costs, you're usually going to be a percentage of the loan. You can either have that percentage added to the sales price, which is rolled in, so there really isn't closing costs out of your pocket. It can just be built into the sales price. Or you can raise the interest rate to have it pay the fees, but that's usually a more expensive way to do it because you have that interest rate the whole life of the loan instead of just a one-time fee on the sales price. But usually you're going to run anywhere. 1% is usually on the very low end on closing costs for title, appraisal, homeowners insurance, all this stuff that's rolled into the closing costs. And maybe 3% on the high end. But again, 3% of a $100,000 loan versus a $500,000 loan is a lot different dollar amount. So it's hard to do a percentage, but it's usually around 3%, I'd say, is a pretty safe average. So if you're looking at a home, you want to do your down payment and then the 3% of the loan amount, not the sales price. And it shouldn't be worse than that. If it is, it's either a way low loan amount or you're buying down the interest rate or something like that. That's a good rule of thumb, is about 3%. Shouldn't be worse than that. You could probably get away with even 2 to 2.5% depending on the sales price. But again, this is where a loan officer, this is where I'm going to be able to sit down with you based on your price range, credit score, down payment, loan program. I can tell you what options are. And I give you options. Say, well, here's the lower fee option. Here's the higher fee option. Which way do you want to go? And that way you have more ammunition to answer this question for yourself, because your situation is going to be completely different, because it's going to be a $500,000 purchase or a $200,000 purchase. And that can change those percentages dramatically on what you're actually going to pay. So that's very important though. You've got down payment and those closing costs. You do want to have both of them factored. You do want to have the conversation about both things. And usually that's where we run into the issue where people say, well, I've got enough money for the down payment, but not the down payment and the closing costs. And that's where we look at maybe 100% financing or something else with the funds. And I've seen it so many times where having the money down isn't as good as maybe paying off other debts. Because $30,000 on a house isn't going to make as much of a deal as putting that $30,000 towards every other debt. I mean, it might be a $200 difference depending on the program to put $30,000 down, but 30 grand might get rid of a $500 car payment, 2 Visa cards. It could get rid of so much more debt to help you qualify for more. So maybe all you have left over is the mortgage loan. And by being able to do more for the mortgage and less for the other debts, maybe you can qualify for more home. So maybe your price range was only $250 with your down payment, but you go with 100% financing, get rid of the other debt, maybe now you're at $300 or $350. So you get to open up your buying power by taking the down payment and using it in other places that might be smarter. That's part of my job, is to sit down and figure out what is the best way to use your down payment, what you qualify for, what the payment differences are going to be, and just help you with your buying power as much as possible. And that's also where cosigners can kick in. I can help you with cosigners, family members, friends. We're seeing that a lot more often where roommates from college or brothers and sisters are kind of teaming up on their first home to give them a chance to get into that first home so they don't have to rent. And then when they go to sell it, they can kind of split that equity and maybe upgrade the house 3 or 4 years down the road. I see a lot more of that, and probably a lot more of that happening in our area, is having to look at co-signing opportunities. But I'd love to help you with that as well. So if you're looking to co-sign, you can check out my website at ryanbolton.com or my Facebook, YouTube channel. If you're watching on these channels, love to work with you on a mortgage loan. All right, let's see what else we got. Any questions posted recently? I really hope the link's working. Maybe I should open up the YouTube directly. I don't know. I really hope this is working. I think I'm live. Oh man, I'll tell you, my nose has been itching. Anyway, this is a new system I'm using. It's called StreamYard. I really like it. Just want to start using it more because it's nice because I can record kind of one video, but it's streaming, hopefully, on Facebook and YouTube. So I guess I could probably add other streams maybe, like if I just other profiles. I don't know if it lets like Rumble and all the other social medias that are out there. Oh, man. All right, see if there's any questions on here. All right, we're going to go to another platform here for questions. How do I keep my mortgage from being sold? You can't. Now, certain servicers don't sell their loan, but it is a security. In most cases, it's a mortgage-backed security, and you'll also see mortgage companies just get bought and sold themselves. Like there'll be a merger between Nation Star and Mr. Cooper or something. So sometimes it's not even being really sold. It's just companies merging or coming together. So, but really they're buying the term of the loan. So I understand where people don't want to have to worry about changing where their payment's going and things like that, but it really doesn't change your loan at all to have it sold. And the more loans are moving around, probably the better the demand is for loans. So short answer is you can't. They're buying the security, and the security is tied to maybe a pool of other loans, and that's the investment that they're purchasing. Now, I usually see it a little more on the front end. Like when you first get the loan, that's when it gets sold to a servicer or gets transferred a little more often when you first get the loan. And it doesn't happen quite as often after that. But there'll still be times where like mortgage companies will merge or close or names will change or things like that happen as well. Now, there are certain programs like Utah Housing. They service almost all of their loans. USDA has some servicing. So it depends on the loan as well. But generally speaking, I would say it's got to be a huge percentage get sold at least once or twice, especially early on. It's just kind of the nature of how these things get securitized, how the money moves around, how the investment works to free up money and more capital to loan for the next loan. So if the loans aren't moving around, then that means you're back to where the banks won't be able to loan any more money until your loan sells. So they can then take that money and re-loan it out again. So part of it's just kind of how the mortgage industry works to securitize and to keep the mortgage moving. Otherwise, they'd just run out of funds. There'd just be a chance where all the mortgage money is loaned out until the mortgage money comes in, and then it's just money in, money out. So it's like, okay, well, the Smiths paid out their loan. Now we can do the Andersons, and that's it. We're done. No more money. You just run out of money if you didn't have a chance to be able to move that money off your books and reallocate it based on interest rates and things like that. So short answer is you can't. Would you rent half your house to keep it? Oh, I don't know. Yeah. If I had to. Yeah. Would you rent half your house to keep it? Yeah. I guess. What do you guys think? That's probably a case-by-case basis, but I would say, yeah, but I really like my house, so I'd rather keep it. And we have a unique house in the sense that we have kind of a little attached, a little VRBO kind of thing. So it wouldn't be as hard because it's almost like two houses. They're very, very separate. They're separated by the kitchen and the living room is the two halves of the house. So it does have a nice little separation. I wouldn't even if we've ever had anybody in that VRBO or that section of our house, we don't even hear them. It has its own bathroom. It has its own little kitchenette. So it really is almost self-contained. So it really makes it pretty nice to be able to rent that out, not have it, sharing the same kitchen or bathroom and stuff like that. It might be a little bit more intrusive, because that's the thing. Once you become from renting, you don't see a lot of people go from renting to owning back to renting unless they really have to, because once you own, there's just something about being able to own your own space. You can put stuff on the walls. You just get to do more to it than a rental, with customizations and colors, and just there's just a pride in home ownership. We always talk about the financial reason to own a home, but there's so many other reasons that are non-financial, like customization, like attached to it. You just feel more planted. You don't feel as transient, and you can color it and change and customize. You can have pets. That's the one thing I notice in our area. It's really hard. I see listings and Facebook posts all the time where people have pets and they can't find a place to rent because people don't want to have pets in rentals because they pee and poop and smell and all that kind of stuff. When you own the home, you can have pets. I love my dogs. I would not want to get rid of my dogs to move back into a rental. So there's more than just financial reasons to own a home. That really is nice. Let's see, any questions yet? I hope that link is working. If it's not, I apologize. If you submitted a question when it didn't pop up, then yeah, let's see if we can find a couple other questions here. See if we can find another couple of questions. Oh man, how about allergies, man? Whew. Hasn't been too bad this year, but I definitely have had kind of a weird little cough that I think is allergy. I don't know. Who knows? Could be something else. All right, we are live city. Sure hope it's working. This is the first time I've used StreamYard, and really like it. It has some cool features that I'm still kind of playing with, but it's just nice because I can kind of record here on StreamYard, yet it's posting it to Facebook and YouTube. So I don't know about scheduling, though. That's what I'm going to have to see, because if I schedule on YouTube, I don't know if I use StreamYard, if it's actually using the schedule that was on YouTube. So still playing with it a little bit, but it's been fun kind of learning how some of the stuff works. YouTube and Facebook and content creation and podcasting. And I mean, it's just been kind of a new skill I've been kind of playing with, and it's been a lot of fun. But it's a little bit of a learning curve. That's for show. For show. All right, let me go back to questions. If you have any questions, you can jump into the chat. I was focusing on kind of first-time home buyers, but we can answer any question that you have. Did I shut it down? Nope, there it is. Get this shut down here. Okay, let's see. What's another good question? How do you go about getting a manufactured home and land through an FHA loan? Does the loan pay for the electrical and water installation also? No, generally not. I think the 203K does allow for that. I'll have to double check on the 203K, but generally speaking, FHA is for kind of an existing home that's already there. Now, you can use the FHA loan to build the house, but typically the financing kicks in after everything's there. So the builder would then pay to deliver the manufactured home, hook everything up, and then the final sales price is what the FHA loan kind of replaces or then funds the permanent loan. So there's kind of two different loans when it comes to building, manufacturer homes, anything that comes with the home's not there yet. That's more construction loans. That's loans that are designed to be more short-term in nature, so they have different risk tolerances, different down payment requirements. And that's where either builders self-fund it with just their money that they've had from years in the business, or their own lines of credit, their own warehouse lines, whatever it might be. And then they say, okay, well, you want model number A, you want it on this lot, we will sell that to you for X. And then that's usually put a down payment on it, they'll get it built, and then the FHA loan pays that loan, or basically pays the builder off on however they got it financed. So there's a lot of ways to skin a cat here when it comes to that type of thing. But generally, FHA is more the permanent final loan after the home is there, functioning, move-in ready, all that type of stuff. That's the type of loan that it's doing. It's not really designed to be a construction loan where it gets the concept from raw land up to a vertical house, whether it's manufactured or stick built or whatever it might be. But you can use FHA to do manufactured home financing as long as it's on a permanent foundation. So it can't be a rented land or a park model or something that isn't attached to the land itself, because that's what makes it real estate. Otherwise, it really is a RV, or it is a personal property and not real estate. So you can use FHA for a manufactured home as long as it's on a permanent foundation. How can I choose the right real estate agent to sell my property? References, check other resources, get some referrals, check with title companies, check with loan officers, mortgage companies. We can kind of tell you who's a good agent, because some of them service certain areas, some of them certain price points, maybe commercial and residential. I mean, there's lots of different agents, kind of little niches that we can kind of direct you to maybe a couple different resources. So, but I've found that mortgage companies, check with them, or title insurance companies like First American Title. There's a bunch of them around the state and the world and the country. And but some of these, Stewart Title, here in town, I really like Infinity Title. Southern Utah Title's good. You've got Eagle Gate Title. I mean, there's lots of different title companies here in town. And Old Republic's another one. I'm going to miss somebody and they're going to get mad at me. But that's a good one too, because they get to see, again, the front and the back end of a transaction. They get to see the agents as buyers and sellers agents, mortgage companies. They kind of get to see a lot more of the ins and outs of each loan transaction and how their staff is, their funders, their closers. I mean, there's a lot of stuff that you don't see that goes on in the background. The title companies have a little more of a sneak peek behind the scenes a little bit, and they're kind of a neutral third party in this whole thing. So they usually are a pretty good source to be able to find good real estate agents or mortgage companies. But obviously, I'd love to earn your business. I do loans in Utah and Nevada. And Patriot, the company I work for here right on Bluff Street in St. George, they have licensing around the country. So I can direct you to other people that might be able to help you with a loan. I want a divorce, but my wife would get half of the property. In many cases, yes, that's one of the reasons we see people having to refinance if you're going through a divorce. And if you know somebody that is, I can help you with this process of getting somebody off the title report or financing. What typically will happen is you'll end up selling the property because maybe the wife or the husband can't afford the home on their own, that they need that other income to be able to qualify. Or if they can qualify, then you usually have to come up with cashing out the other person. And usually there's factors and all that kind of stuff. But it's definitely a part of being able to get people freed up with their equity or get the loan out of their name. That's probably the most common thing you'll run into, is that the wife is awarded the home, but the husband has to qualify now for that mortgage and the new one. So you have to refinance to take his name off the loan. You can take him off the property, but he wouldn't be off the debt without actually going through an actual refinance, which a lot of people are upset with because now they have to go to today's interest rates. Maybe they have a 2 or 3%, 4% interest rate, but now they have to refinance because of the divorce and they have to go to today's rates. That's just the nature of the loan. You can't really take the person off the loan and keep that loan term. So if you do know somebody who's going through a divorce, I can help with the cash out. We can do a line of credit. We can do a full refinance if that's what's required. Or if it does come down to it where you have to sell it, then we can help with that as well, with getting you with an agent that can help sell and just distribute the equity. And I have seen times where you can give up more equity, but then maybe keep your 401k or keep your retirement or change the alimony child support by just negotiating, okay, well, I get the house and you keep your retirement, or something like that. There's ways to be able to get it negotiated. And I've had to do a lot of those. So if you need help with that, I can help with that. Let's see what else we got. Let's do another topic. Oh. If you have any questions about real estate, mortgage, credit, First-time home buyers, that's kind of what we're focused on, but we can do anything you'd like. Here's a real estate question. How do I transfer my house to my daughter? Now, here's a tricky part here. If you bought the home and you transfer it to your daughter, you don't get the increase in cost basis. Meaning that if you bought the home for $300,000, it's worth $600,000, and she goes to sell the property, she has to pay the capital gains from the $300,000 to the $600,000. So you don't want to just transfer or warranty deed. It's also known as a quick claim deed. You don't want to do that in most cases. You're better off setting up a trust that she is the trustee or the beneficiary of, because if something were to happen to you, then the home's value increase from what you paid for it gets raised up with a cost basis increase to then they can sell the house without having to pay the capital gains on that increase. So you don't want to just transfer the home into your daughter's name, because then she would have to pay the property taxes or the capital gains taxes if she sells it, unless she's going to move into it as a primary residence. And I think there's still going to be some capital gains issues there as well. So the best thing to do is talk with an estate planner that can help you kind of set up the trust, just to make sure you're not laboring your daughter with just a huge 25% capital gains if she goes to sell the property. So you don't want to just warranty deed or quick claim them onto the property unless they're also living in the property. But that's where an estate planner is going to be your better option. I mean, that could be a huge hit. If you bought the house and you only, bought it for $300,000, $200,000 is worth $1 million, then all of a sudden that difference is what they pay the capital gains on. That could be a huge tax hit when it could be avoided. It can be very easily avoided if it's done through a trust or done through an estate planner. So if you're in that situation, don't just warranty deed the child onto the property. They're just going to owe a lot more in taxes. How do people borrow $1.2 million? That's a specific number. How do people borrow $1.2 million from the bank to buy a house, really have the money for the house? Well, either savings, sold another house, income. I mean, yeah. How do people afford a $70 million house? I mean, because they have the money to afford it. Stay in school, I guess. Trade school. Too many people go to school just for nothing. Go to school for a reason. Have a end goal in mind, like an end industry or something that seems to make sense. It just seems like, I've been out of the school thing for so long, but it seems like anybody I hear talk about the schooling, the degrees that some of them are getting, and the cost to get some of these degrees is like, holy moly. That's the part that surprises me, is the same cost for a degree to be, X or Z. And it's like, this one pays nothing, this one pays everything. It's like, I know everybody wants to live their passion and live their job, but there's some great industries out there that pay good money that you can target, like trade schools and all kinds of different things that will pay equivalent to what it costs to get the degree. I just think some of these degrees are just ridiculous, the cost for what they get. And the job at the back end of it doesn't pay enough to justify the cost of getting the degree. I think there's definitely something wrong there. But like I said, I've been out of that world for so long. I don't know how it all works, but it just seems like there's not an end goal, or there's just certain degrees don't really have a job that justifies the cost of getting the degree versus taking that same amount of money and getting into a trade or other things that can be just as rewarding, if not more so. It's still going to be a job. But everybody has to love every job that, no, you don't have to love it. There's jobs that are fulfilling for a lot of other reasons. And I think there's something in our last couple of years, last couple of decades, generations, whatever it is, that you have to love what you do. No, you don't have to hate it, but have to love it. Like, there's this idea that you have to, love what you do and you never work a day in your life. Well, yeah, great. It just doesn't exist very often for most people, but I don't know. I think that the degree thing can be very, very interesting, especially for the cost for some of these degrees. It's like, yikes, why? All right, we're getting off topic. Let's see. Are you eligible for any first-time homebuyer programs with zero down payment? That was just posted. It sounds more like an ad than a posting, but yeah, there's 100% financing programs for non-first-time homebuyers. So yeah, 100% programs work for a bunch of different reasons. Is it beneficial to pay off a house faster in order to avoid dealing with property taxes later in life? No. So having a loan on the home usually does not affect the property tax. In fact, I don't think there's a single state where what you owe affects the property tax. Is what's worth, what you paid for it. Those things factor into property taxes, and it's regardless if it's free and clear or whether you have a mortgage on it, you're still going to have property taxes. So now at your age, you might get some property tax reductions, or if you're a veteran, I know we have some exemptions here in southern Utah for certain age groups or veterans or something like that, a reduction of the property tax, but it doesn't go away because the property taxes are funding other projects within the county, the state, the city, whatever the tax is. So paying off the house wouldn't all of a sudden avoid property taxes now, and it would affect when you sell the home if there's capital gains taxes. So I think the terminology here might be a little bit wrong, because you'll have capital gains, depending on if it's a primary residence or not, will determine kind of the capital gains. But the question reads, is it beneficial to pay off a home faster in order to avoid dealing with property taxes later in life? That you won't avoid property taxes by having the house free and clear. So no. Does my mother have to sell her home if her husband died with no will and his children want money? Oh. No. Now probate, but if it's a husband and wife, I don't think so. But I don't know. It depends on the state. That might be an estate planner question, but I don't think no. If she's on title or on the loan, so there might be some of those factors. Most likely, hopefully she is. So if she's a husband and wife combination, hopefully she is on title, so she's the owner of that home. But the kids can't force mom to sell her house if her husband dies. So I'm going to say no. Maybe correct me if I'm wrong on that. Depends. Maybe there's some states out there that maybe, but I don't think so, because husband and wife, the protections of that wouldn't allow the kids to then say, hey, mom, we want dad's money. We want his half. You have to sell the house. I don't think so. I would say no. My parents left me a small house when they passed, but my sister-in-law sold it and got the money. How do I get the money from her to be able to buy a house for me? The parents left me a house, but my sister-in-law sold it and got the money. Wow. Woo. Well, it depends on how they left the house to you. You have to show documentation or proof, because she wouldn't be able to sell it without being an owner of the property. So she'd either have to be the trustee on the will or have some sort of ownership on the title. She can't just sell something she doesn't own. So if your parents like warranty deed, or you're the trustee or something like that, she wouldn't be able to sell it without her owning it. Now, so it depends on how you can prove that the house was left to you. If it was and she sold it, then there's possible title insurance to be able to say, hey, I was the owner of that home. She wasn't. You need to, the title insurance might kick in that sense. So it's interesting the sister was able to sell it without giving him the money, without him signing off on it. That's an interesting one, but you'd have to prove that you really were awarded the house. Can't just be something like a voicemail or something. Say, hey, grandson, or I guess parents in this case, we're giving the house to them. Yeah, so there's a lot going on here that probably isn't the full story, because if they really left the home to you, if it was legally done, then she couldn't have sold it without you signing on the documents. If she doesn't own it, she can't sell it. So the buyer can't transfer the title without dealing with the owner's policy, the lender's insurance, all this stuff for the title insurance would have to be part of it. So there's probably a lot going on here, but she couldn't have sold it if she wasn't already an owner somehow. So either you didn't get recorded, and boy, there's a lot of ways this could have happened. But technically, yeah, she wouldn't be able to sell it if she wasn't the owner, because the title insurance, the next buyer would have to get the title, would have to show she could sign for it. There's a lot of stuff to be able to move that ownership. So if she didn't have the ownership, she couldn't do all those steps without you signing off on it. Now, if you signed off on stuff not knowing it, and then the wire came in, she just took the money, and then she stole money from you, and you have to go to the cops and just say, hey, this money was supposed to go to me. Or if the title company wired it to her, and you could go after them. So there's a lot going on there. I'd love to hear the backstory on that. So call me. I'd love to help you more and figure out what to do there. But that's an interesting one. That's a fun question. Okay, here's another kind of interesting one. If my fiance and I own a home with no mortgage and both our names are on the deed to said home, thanks for clarifying, can his child take the home from me if my fiance passes away? No. If you're on the title, you are an owner of that home. If they pass away, it doesn't mean the kids now become the owner of that home unless it's in a trust or a living will or something that then dictates what happens when he passes away. But the short answer is if you're on the deed, you own the home. They can't just come and take the home away. You're the owner of that particular home. I still think getting a trust, if they haven't passed away, estate planning people, it's worth its money. It really just get your estate planning taken care of so all this stuff gets resolved and taken care of and probate doesn't kick in and taxes don't kick in. So many things that become a nightmare after somebody passes away if you don't go through the estate planning. So just really recommend that you do that. When selling my home, can I just let anyone in without the realtor being present? Technically, yes, but that doesn't mean that you are out the commissions or anything like that. And then secondarily, their job is to help pre-screen. Their job is to make sure that you're not sending somebody in or put yourself in a situation where you could be injured or hurt or stuff like that. So I'd be pretty leery about just letting anybody in. But I mean, if the sign's out front, you're going to have somebody knocking on the door. It's kind of up to you on take the right safety precautions. But there has been stories where people find these homes and take advantage of people that are there or case the place to be able to come back and steal from it. So there is some protection there, and that's part of what their job is to do. So I definitely will at least call them and let them know what's going on. See if they have a real estate agent they're working with. So if they're driving around and they have an agent with them, you can feel a little bit better. But if they're just by themselves and they just knock on your door and walk in, you might say, hey, talk to my agent, schedule something with my agent. It just can be a little bit of a safety thing as well. So I recommend no, but not in every case. There might be some case, use some common sense, protect yourself, make sure maybe family members are there, more people are there. Make sure all your private, usually if you're selling the house, maybe it's either close to vacant or all your personal effects. Just make sure it's not a target for thieves and stuff like that. But I know women have been abused in these situations where they're just casing the properties. In fact, even female real estate agents have to be worried about this a little bit, where they're going into houses and into basements and stuff with seller or buyers that they're just to take advantage of them. It's really just a sad, scary part that pops up. There's been a few real estate agents that were killed by somebody that was able to kind of lure them into the basement of a vacant home that was for sale. So you just got to be careful when it comes to that. Just use some common sense. And I would say more often than not, at least call your agent, let them know, have some pre-screening done, use some common sense, and just make sure you take care of yourself and protect your asset and your family. What makes land and deeds different from regular real estate agents? What? Land and deeds differ from real estate agents. Well, real estate agents are humans. Lands and deeds. Land is land. Deeds are pieces of paper that tie to a piece of property. So that's okay. Great question. A lot. What makes lands and deeds different from real estate agents? About everything. I don't know what's this. Okay, what's the similarity between a real estate agent and land? They're both made of atoms. Yeah. That's probably typed in there incorrectly. Let's see. My son refuses to buy me out of the mortgage and wants to just remove my name when he refinances the house. What can I do? Well, you don't have to remove your name from the mortgage without actually signing the paperwork to do so. So that's where when families can be difficult, family, friends, you just want to get things written down. You want to have a contract. You want to keep it business as normal because you can ruin family relationships. There's so many things that can get ruined when you cross the boundaries of kind of family business, friends business. And so sometimes it's better just have things laid out. So my guess is, my son refuses to buy me out of the mortgage. So there must have been something where they agreed to split the equity or something like that. And now that he's taken her name off the loan, he doesn't want to cash out that equity. And you can get your name refinanced off the loan without taking your name off the property. So that can be something where you at least tie to the property until he sells the property. So that way you get your money when he sells instead of just refinancing. But I don't know what the benefit of refinancing is without taking your name off of it because most likely rates and terms are going to be worse. So what can you do? You don't have to sign the paperwork. You don't have to sign the deed that allows for this to happen until you come up with an agreement. Say, nope, I'm not signing the agreement until we come up with a number that you owe or we agreed on or something like that. So You have all the power in the world to just say, no, not sign it. Now, it's going to ruin the relationship. That's the part that's going to suck about all this. So there's a lot of backstory, I'm sure, that's on that. But what can you do? You don't have to sign the paper. You can't force you to sign it. So, yeah. What do I do if my realtor refuses to do an open house for my house? Refuse is a strong word there. I would check kind of why. What's the reason for not doing it? If they're not willing to do the open house, then what are the marketing are they doing that offsets it? Why would that be a not a beneficial thing? I mean, I don't know if it's remote. I mean, there's a lot of reasons why you wouldn't do an open house. Maybe it wouldn't just be successful. Like that's kind of a common thing for agents to do, but maybe in your case, it wouldn't be that successful. It's kind of a waste of time to do it. But also what you'll see is sometimes the agents will have other people in their office that would be willing to just man the open house for leads and maybe split the commissions, or there's other things you can do, but generally find out why. I would say, why are they refusing to do it? Like, what's the reason? What's the other marketing that you're doing instead? If they still refuse to do it, then find another real estate agent. If you feel that's really going to help you sell your house, say, okay, I want out of this contract, talk to the broker and just say, hey, I want to do this open house. Find somebody else within their office that can help with the open house, or just pull your listing from them and go with an agent that will. But I would say there's got to be a why they don't want to do it. And maybe just because it's not effective or for your area or don't have the time or don't want to do it, then that's when you say, okay, I'm going to find a different agent. That's what I would do. All right, how we doing on, whoop, getting a buzz on just a text message. Oh. See how we doing on time. Oh, man, we're almost 2 hours. Whew. I didn't realize it was going that long. Okay. How will mortgage lenders react to increased home insurance rates in 2025? We've already started seeing that kind of filter its way through the system. Really, the homeowner's insurance is a yearly premium usually, so we divide it by 12 and add that to the payment. So it doesn't really affect mortgage lenders all that much because it's usually not a huge factor in the debt ratio when they do go up. So we still are checking coverages, making sure the coverage is what we need it to be. But it is something where it does maybe reduce buying power a little bit, because now if the insurance is $2,000 a year instead of something else, then divide that by 12. We have to add that to the payment, and suddenly something that was $150 a month, maybe it's $175. So it's not a huge, it's not as much of a huge impact on the mortgage lender per se, other than getting the insurance can be an issue. So if they can't even get the insurance, then they won't be able to get the mortgage loan. So that's probably a bigger factor than maybe the increase in the cost. But yeah, that increase in cost is just going to filter its way down, just like property taxes, just like anything else, is going to be part of the total payment. And if all of a sudden that moves them out of qualifying, then they have to buy a slightly cheaper home. But again, it's usually divided out by 12 months. And so if it's, unless it's just a dramatic increase in an area, which I'm sure maybe parts of California have seen that, or they just don't even insure parts of Florida and certain things because insurance has gotten harder to get in the first place. But yeah, if all of a sudden the insurance doubles and triples, then that divided by 12, add that to the payment, then that might lower the buying power of somebody because the insurance is a lot more expensive. So that's probably the bigger thing. It won't really affect lenders other than maybe shrinks the buyer's pool a little bit, maybe depending on the area. So I think that's going to be a lot more localized is where that's going to affect people. Let's see. What happens when there's not enough money to pay debts, but there's a house in the estate? So if the debt, it depends on if the estate's in a trust or living will that does some protection for that type of stuff. But generally, if there's probate issue and there is assets to pay off debts, then those assets get sold to pay off those debts. Now, you can go in and purchase the home essentially, or do a cash out loan or something to be able to pull out some money from the cash and then pay the debts off. So there's some moving parts on that and how it's set up. But again, that's where estate planning can be a real tax savings, a burden on your family if you've passed away. So I really recommend checking into estate planning, because that can really save your kids or your beneficiaries a lot of headache when it comes to certain things like that. But generally, if there is assets, a probate situation, somebody's passed away and there is debts and there's assets to pay those debts, those assets get sold to pay those debts. Possibly. This is a good one. Is it possible to purchase a home from somebody and delay the closing until your own home is sold? A couple ways you can do it. You can do it contingent. So you can say, okay, I want to put this offer on this home. I want to make it contingent on my house selling. The downside with that is the seller will usually do some sort of 72-hour clause or some way to be able to remove that contingency so they can continue to market the home. So that's one thing you can do there. Next thing you can do is a bridge loan. So you can actually do a loan that pulls the equity out of the current home you're living in to put down or even pay cash on the next home. That way it's not contingent on selling your current home. These are known as bridge loans. I know it sounds weird to have it's not a loan on like a bridge, over the water or, a metal structure, bridge, but it's bridging the time between when you sell your current home and pulling out the money for the down payment on the next home. So I'd look at maybe a bridge loan that allows you not to have that contingency built in there. The next thing you can do is it's closing on it that's going to be the issue unless you have the money to pay cash or something like that. But you can put it under contract and then don't have to close on the contract until your house sells if the seller agrees to that contingency. But almost every time I've seen that come up, the seller wants to be able to get out of that contingency and basically give you first right of refusal and say, okay, we'll agree to your terms. You can sell your house, but I get to keep marketing the home. That way, if another buyer shows up that can pay full price or whatever, I can then go back to you and say, okay, I have a new buyer. If you're ready to buy, you can remove that contingency. If you can't, then you get out of the way and this new buyer can show up. So really that's the two most common is a contingency with a 72-hour clause or using a bridge loan to pull the equity out of your exiting property to pay cash or have enough down payment to qualify for the next house. Love to help you with a bridge loan. These are great loans for a lot of reasons. One, you can get completely moved out and moved into your new home so your other house can show easier. It can be vacant. You can clean it up. You get all your personal effects put together. You kind of get settled in the house while you're trying to sell your other house. It can help you get a better price. You can stage it. You can show it more often. You can get usually a better price for it than you having to deal with open houses all the time or people coming in at random times or, getting a call from the agent. Hey, I've got somebody that wants to come by at noon today. And you're like, well, I'm working. I can't get there. And you miss out on that buyer. I'm telling you, those bridge loans are an awesome tool to get moved out of your home, clean it up, get it ready for the best possible sale, get moved in and settled. The stress it reduces, pulling out the money. You can use the money to put down, pay off debts. You can use the money for whatever you want to use it for. It really is a great tool it's well worth its cost. I mean, well worth the cost to do that type of loan. I've seen so many people that have to be moved out and moved in on the same weekend, because they sold, they got another buyer coming in. It's just a frantic weekend, especially if they've been in the house for 4 or 5, 10 years and all the stuff they've accumulated. It's just a mess sometimes. And if you can just take your time to move out and get settled, it's amazing tool. So if you are looking at selling your home, you have some equity, you want to upgrade, but don't want to have to sell your home first. You don't want to have to deal with moving into a temporary house until your house gets built. There's so many things you can do with those bridge loans. So check me out at ryanbolton.com. I'm here on Bluff Street right here in St. George, Utah, but we do bridge loans all over the country. So I'd love to help you with that type of financing if that's what you're looking for. What else we got? Let's see how much time we got left. You can post questions, I hope. I hope there's a way, because I don't know if it posts to Facebook. It looks like it's linked to where I can, any comment should come into Facebook or YouTube and then come into my screen, I hope. That's kind of why I use this system. It's called StreamYard. It allows you to stream to multiple, one video, but streaming to multiple platforms. So it's kind of a cool little system. So just kind of trying it out and messing around with it a little bit. I got a little better lighting in my office, so it looks better, huh? Ooh. Lighting makes a big difference. It really does. And I think I need to upgrade the camera. It's probably the next little, maybe. I don't know. It looks okay, I think. At least on my screen, it looks okay. I don't know what it's looking like on YouTube and Facebook, but oh well. How can you tell if someone is flipping a house or just bought it to live in? Well, I don't know if you can just tell without just knocking on the door, because even if they're remodeling it, maybe they're going to move into it. So you might just have to talk to the contractors and see if you can get a hold of the owner. Or, you can check county records and just see who the owner of record is now. If it's like an LLC or something like that, there's more of a likelihood it's a fix and flip, where if it's in an individual name or even a trust, you're most likely somebody's going to be living in it. Not always, but that's one way you can. That's a little bit of a telltale sign without having to talk to contractors or just knock on the door. Is if it was purchased like with an LLC, that usually is property flipper or a renter or investor that's going to rent the home after it's remodeled. But usually have people going in and out of the house that are doing the repairs. You can just say, hey, just trying to get a hold of the owner. You can and even just say, hey, They may not give you the number, but you can say, hey, here's my number. Can you give it to the owner? I'd like to see if they're interested in selling the house. They may know. That's probably what I would do, is just ask the people that are going kind of in and out of the house that are repairing it, or just check with the ownership and just see if it's an LLC or an individual. And sometimes if it's an individual, it'll have maybe a different mailing address that's different than that house. So that can be another indication that maybe it's a second home or going to be a rental property or a fix and flip. If you just retired and somebody offered to buy your home for way more than you thought it was worth, and you could move to anywhere in the United States, where would you go? Oh, okay. This is just kind of more of a, if you just retired and someone offered to buy your house for way more than you thought it was worth, and you can move anywhere in the United States, where would you go? Well, I love Southern Utah. So I don't think I would move. My wife, I don't think you could offer enough for my wife to sell the house. There's got to be a number. I mean, come on, babe. There's got to be a number, right? But I would say it'd be pretty tough for her to move. But hypothetically, we had property in Tahoe. I really love the Tahoe area, like Tahoe on the Nevada side. I just love the Tahoe area, but all year round would be a little tricky because I'm not much of a snow person living in Southern Utah, obviously. But having kind of a summer home up there and a winter home down here would be really, really cool. The distance between the two would be a little bit tricky with our current lifestyle, but that's a good question. So if you just retired and offered you, where would you move anywhere in the United States? Yeah, I can't think of anywhere else. I really like Tahoe. That's probably my next favorite place other than here. I really like the Carolinas too. The summers there suck. Sorry. Once you live in a place without snow and humidity, it's really tough to go anywhere else. Yeah, it can be hot, sure, dry, sure, not as colorful with trees and stuff like that, but I really, really like Southern Utah. I love the climate, love the red, love the green contrast. I love the temperature and the climate. I just really, really like it here for 90% of the year. Yeah, there's 2 months, a couple weeks, so it gets a little brutal. But it's like you're going to lose 2 or 3 months to humidity, snow, or heat, and heat is way better. Way better. Humidity sucks. Snow sucks. At least for me it does. You might be a snow person. You know, you snow people out there. Yeah, it's great when you're sitting inside with a hot cup of cocoa or coffee or whatever you like to drink and just have the fireplace going. Yeah, it's great. But driving in it, getting out and snow plowing and trying to get anywhere and do anything, and yeah. Nope. When you go one winter without winter, it's really tough to go back. Really tough. So, babe, are we selling? If you're watching, Booface? That's what, Booface? All right. Let's see. If my husband and I separated or divorced, will I have to buy him out of his share of the mortgage if he moves out and I stay in the house? Depends. In many cases, yes. Depends on if you're, and even if you're awarded the home in the decree, that still is requirements to remove him off the mortgage. Otherwise, he has to qualify for that debt plus the next house he's going to buy. And usually there's equity involved. There's usually some sort of split of equity. So I've seen times where it's a 50-50 split of the equity. You have to sell the house, or one of them has to buy out the other person. I've also seen, again, where it's in lieu of other things. So it's say, okay, I get the house, but you keep the 401, or I keep the retirement, no alimony, child support, but you get the house and all the equity. So it's plenty of ways to negotiate that. But what I see more often than not is having to sell, because usually the spouse or the wife, usually, not always, usually the wife can't afford the husband's income. So if the husband's the primary breadwinner, and all of a sudden now you have to pay off the existing mortgage plus cash out the equity, it usually means a pretty significant increase in the payment. And that usually means that, especially now with interest rates higher than what they were, you know, if you've bought the home 4 or 5, 10 years ago, the rates were probably a lot cheaper than they are now. So not only do you have to bump up the interest rate, but now you have to bump up the loan amount to cash out the other person. So usually in these situations, especially now, I'm seeing where people have to sell. It's also the cheapest way to get access to the most money, to just separate, get the property gone, free up the equity to then go off and buy another house. So more common now I'm seeing where people are having to sell the property to get rid of the payment, get rid of the mortgage debt in both of your names, and to free up the equity for both people to move on and buy another house. So hope that helps. If you need help with that, I can help with the refinance, help with an agent to list the house. We have investors that'll buy it if it's distressed and you guys just want to walk away and just get done, get as much money right now as you can. We have people that'll come in and just renovate and remodel and clean up the house to get the most for the sell. It's always tricky with kids involved, going to school and trying to figure that out. It's divorces are ugly in many cases, but that's something we can try to alleviate a little bit of that to run the numbers for you and figure out what you need. We can do a line of credit as well. It just depends on if the person's on the note, on the loan itself. The only way to remove them is to actually refinance, which means you're subject to today's interest rates and you can't kind of keep your rate and remove a cosigner. So it gets a little sticky. How are we doing on time? Again, you can post any questions. I was focusing most of this on first-time homebuyers, but I can answer any questions about real estate, mortgage, credit, anything else. Yeah. Any questions, go ahead and submit. What are the pros and cons of buying a house on the first or ground floor? Well, don't have anybody above you, so usually less sound, less noise, less stairs. So, that type of stuff. Yeah, normal stuff. Let's see. What are the consequences if your parents' home decreases in value while they're still paying their mortgage, resulting in them owing more than the property is worth? Boy, I don't remember the last time that was a real issue. We saw that in 2008, that type of thing, depending on the timing of when they bought it. So you still owe the debt, regardless of what the house is worth. So the payment is still owed on it. I think it's pretty rare. And that's why you saw a lot of people walking away in 2008 because they didn't have any skin in the game. They didn't have down payment. They could get a cheaper payment. They could rent for cheaper. There's a lot of factors that kind of factored in why people just walked away because they were upside down. This is pretty rare now, but if you walk away, you're still going to have the foreclosure. It's going to hurt your credit, all those types of things. And it's really pretty rare. It depends. It's got to be a very localized situation, or maybe they just way overpaid for the house. But I don't know many people that are actually upside down in their properties now. Maybe this is an older question. No, it looks like it's actually a fairly recent question. That's interesting. I wonder where this has happened. Now, there's pockets. Real estate has pockets where maybe you have a plant close, or I remember here in Utah, we've got the oil fields and they kind of go, it's a feast or famine. They're either making more money and they don't know what to do with, or all of a sudden they're laying everybody off. And so those markets can really see really big fluctuation in rents and home prices. And I remember Washington, D.C., there's been all this firing and Doge and all the stuff that's happening in D.C., where they had like a record number of properties hit the market because people were losing jobs and they were quitting and having to move. And so that could affect those targeted areas. Usually real estate is still very much a local type thing. So there can be areas where the foreclosures really spike or property values really drop because of something external that happens to a job. And usually jobs, it's usually tied to some sort of industry closing or decreasing, or something, mining, a business closes, a warehouse closes, a factory closes, something like that really can affect the value of a certain area. So that's where you can see you could become upside down, but it's pretty localized right now. Almost everybody has equity in their home. In fact, I think it's a record number of equity. I saw a report, I wonder if I could pull it up here, that showed like the average home in America has like $300,000 of equity. So it's pretty rare to have anybody upside down, especially if they've owned a home for a while and they put money down to begin with. So yeah, that's going to be very case by case. But what are the consequences? The payment's still due. And if you don't make the payment, they take back the collateral. If they don't have the insurances and stuff like that, they can go after you for the difference. So it's better to just kind of work with the lender to try to sell it if you want to just sell it for less than what you owe, which is called a short sale, or just wait it out. And hopefully the payment on that mortgage is probably cheaper than replacing it. So even if you are technically upside down, you still might be better off just staying in the home, because replacing it would be probably harder with either rent payment, tax benefits you're still getting, and just wait it out, wait for the appreciation to come back. Let's see. If you could warn a new home owner about one mistake, what would it be? Oh, why is it always got to be just one thing? Come on. Home owner is a little different than a home buyer. So I would say let's do with home buyer. The big mistake I see is not doing a home inspection. I think that's such an important step outside of starting with pre-approval, calling me for a loan. That's a big step, whether it's me or another lender. Just getting the pre-approval started early is one of the best tips I can give people. You can check your credit. You can make sure your ducks are in a row. You can make a stronger offer. You can fix any red flags. You can just do so much if you start the pre-approval a little bit early. But once you're under contract, getting that home inspection, I think that's very, very, very important. After that is knowing the dates, just knowing when your settlement deadline, knowing kind of when your dates are going to expire. Just be aware of those things to make sure you don't pass a deadline and then end up losing your earnest money. And then after moving into the house, not getting a home warranty might be something. I mean, I think those home warranties are really valuable in case the water heater or something breaks in the first year. Yeah, I think that's probably, that's the biggest mistakes I think that I see. I've been renting my place for 3 years without a lease. Can they evict me for not having renter's insurance? No. Is there anywhere in the country where renter's insurance is required? I don't think so. This is a little different. This isn't mortgage loan ownership. This is renting. I don't know why it's in this category, but I guess it's just under real estate. And technically, if you're lease to lease, it depends on the state. I think there's some provisions that if you've still been paying your rent, and even though the lease is expired, it can go month to month. So they can still give you notice to say, okay, now you have this much time to either renew the lease or to move out. So they can do that. But I don't think renter's insurance is a reason they can evict you. I don't think so. I can't think of a single state that says, unless it's in the lease, specifically says you have to have it in the lease. So if it's in the lease that says you have to have it, but I don't think they can force you to have renter's insurance because that just protects your stuff, doesn't protect their asset. So I would really say no. But that doesn't mean they can't find some other reason or give you notice and say, well, you got to sign a new lease. Here's our new terms. If you don't want to sign them, then you have 60 days to move out, 30 days, whatever's required by the state, especially if you've gone month to month. That's a long time. That's a long time without a lease. I don't see that very often unless it's family members or something like that. All right. Any questions, comments? Subscribe, like, share, notification bell. I don't know how this stuff works. I'm just some mortgage guy in Southern Utah. What loan type is best for the first-time homebuyer? Whatever loan program they qualify for. Really, that's. There are certain loans that are more tailored to first-time homebuyers because of what makes a first-time homebuyer is typically less money down, lower credit scores, job history that's a little more inconsistent. Those types of things usually help with the first-time homebuyer, but doesn't mean you have to use a first-time homebuyer designated loan program. I mean, it gives you a little different guidelines more than anything. But the best type of loan is the one that fits your needs, that fits the payment you want or credit score that you have, or all those things factor way more in than one size fits all for first-time homebuyers. I've seen first-time homebuyers that put 40% down. They get an inheritance or something, or they save for a long time and they're able to just put a big lump sum down, and they don't really need the first-time homebuyer down payment assistance programs because they have the down payment, or they have higher credit scores, or they're a cosigner, or lots of other factors that determine more so than just the first-time homebuyer designation. How does a bad tenant affect the rent market value of a property, particularly if they do not pay rent? How does a bad tenant affect the rental market value of a property, particularly if they do not pay rent? Oh, that's an interesting. It shouldn't, because the market value really shouldn't have any effect on other than the condition of the home. And the rental market value is still based on the average kind of dollar per square foot of because the lease is still there. If they're not paying it, then that doesn't, it shouldn't affect it. Because I don't know if they pull up a rental market analysis and say, okay, well, there's 10 houses that are this square footage that rent for this amount, but this guy's not paying, so we have to. I would say it doesn't. I can't see how that would affect it. Now, it affects them and your ability to correct the rent and get them out. And I mean, bad tenants have other effects, but it doesn't really affect the market. The rental market value of the property doesn't affect by a bad tenant. Oh, excuse me. Do people give unconditional consent to the buyer's bank for the creation of a mortgage on the property for a buyer to avail a home loan? To avail a home loan. Do people give unconditional consent to a buyer's bank for the creation? No, I don't think anything that's an unconditional consent. There's authorizations. So when we do a loan, we usually get a borrower's authorization that allows us to verify like their employment, where we pull the credit score. But it's getting less and less where we can use it for stuff without the borrower being involved. Because there's so many security things, there's so many protocols now where the buyers have to be a little bit more involved, or they have to initiate the requests. So there is some automated stuff that's coming available, like salary keys and other things to help us with verification of employments. But there's not unconditional consent. Because even if there was, man, they'd be signing loans that they didn't need to sign. I mean, yeah, there's so many disclosures, DocuSign, physical signatures, notarizations, all this stuff that's designed to protect these loans and the buyers and the consumers and all this stuff. That doesn't mean there's not ways that mortgage companies commit fraud, or not mortgage companies as much, usually loan officers. I don't know very many mortgage companies that commit the fraud. It's usually an individual loan officer that's pulling some fast ones or doing some stuff like that. So you don't see like Chase Mortgage committing mortgage fraud very often. There's maybe violations of fees and stuff. I mean, there's stuff. Wells Fargo, they get in trouble for stuff. I mean, that's going to happen. But out and out fraud, I don't. It usually comes down to that loan officer or a team or a couple loan officers teaming up together to defraud the system in some way, shape, or form. But no, I don't see unconditional consent, because they'd still have to notarize and sign the document to get the loan funded and all that kind of stuff, which, yeah. So I would say no. See if we have another one here. Let's maybe jump in and refresh the category here. And again, you can jump on. You can post a comment. We can answer it for you. Appreciate you watching, asking questions. Let's go there's mortgages and home mortgages. All right, let's do home mortgages. Why is securing a good mortgage rate important? Well, it affects your payment. It affects how much you pay over the entire life of the loan. But what's good for one person might be different for another person. Sometimes the rate is higher but is cheaper. So depending on how long you're keeping the home will determine whether or not you're better off with buying down the interest rate versus just taking a higher interest rate with lower fees. So that's part of my job, is to kind of sit down and say, okay, here's what you qualify for. Here's your loan terms. Here's kind of option A, option B, one with lower fees, lower rate, higher fees, whatever combination makes the most sense can be different for every single person. So what's a good rate for you might be different for somebody else. Maybe a good rate is way more expensive than the higher rate. So everybody wants the lowest possible rate, but sometimes it may not be the best possible program. There might be other features with that aren't as good. So that's part of my job, is to figure out what's better. Like some loan programs have a cheaper rate, but higher mortgage insurance. So sometimes it's like, okay, well, the overall payment is more expensive on this loan, even though the rate is actually cheaper. So that's part of my job, is to sit down and say, okay, here's the different loans you qualify for. Here's the best loan that fits what you're trying to do, and show them kind of the why behind what rate to fee combination or different loan programs make sense. Because it's not always rate. Rate is important. That's probably the most common question everybody asks. What's the rate? What kind of rate can I get? But there's way more questions that are just as important that I like to help and sit down with my clients and figure it out. Like, what if you get a great rate that's 5% instead of 6%, but the 5% is an adjustable rate with a prepayment penalty, or you have to put more money down and you have to have higher mortgage insurance? I mean, it's not always rate. Rate's an important part, don't get me wrong. But there's a lot that goes into what's the best loan for a client. That's what matters more. What role does a home equity appraisal in the U.S. play when refinancing your mortgage? A home equity appraisal. I don't think there isn't a home equity appraisal. It's an appraisal. So there isn't something where, okay, this appraisal, now I guess there's a little differences on purchase versus a refinance or a line of credit, but either way, its appraisal doesn't really factor into that. So the appraisal is a big part of getting a refinance because it determines the loan to value. So the more distance between the mortgage and the value, the better the rates and terms, the better the interest rates, the more cash you can pull out because you got more equity to draw from. So an appraisal versus what's already owed will determine kind of the loan to value. And the second mortgage is added on top of that. So what we call a CLTV, or combined loan to value, the balance of the first and the second. And usually home equity lines of credit are going to be limited to about 90% of what the home is worth. The more you can be under 80% or less, the rates and terms get better. So it's all about risk. Interest rates are really just a risk factor, just like insurance or life insurance and expectancies. And this time, that's really what interest rates are doing. So the more you can offset the risk, the better the rates and terms. With credit score, down payment, loan to value, time on the job, debt ratio. All these are kind of risk factors that determine the type of loan you're going to qualify for. My credit score is 540. How can I buy a house? Much more down payment. There's programs that go pretty darn low, but the more the credit score is low, the higher the rates and terms, the more down payment you typically have to do, and almost every single time you can get your credit score up. Just work on the credit for 90 days. Why is the credit score 540? Let's work on that for a little bit. Then you'll get better loans with better terms and better situations. But I know lenders go down to like a 500 credit score, but they want a lot more money down if they'll even do it. And it depends on why the score is the way it is. If you just got out of bankruptcy, it's going to be a no. If you just got out of foreclosure, it's going to be a no. If you have 10 collections all over the place that are currently actively judgments and collections, it's going to be a no, even if your credit score was somehow higher. So part of it's why it is the way it is. But in most cases, if it's 540 and all the other boxes are checked, you just have to put a lot more money down. Where if you work on getting your score to 620, way more doors open up. Less down payment, better rates and terms. You're just far better off working on your credit than just trying to find a loan that will work. And to be very honest, most people with a 540 credit score don't have money down. Otherwise, they wouldn't have a 540 credit score. They'd be able to pay their bills and stuff like that. Now, there's exceptions. Sure, there might be somebody with collections or just went through a divorce and bankruptcy. And sure, there's going to be other reasons. But generally, people with that credit score also don't have much money in the bank. And so they need 100% financing with a 540 score, and that just doesn't exist. It just never will. So building up the credit, not only with mortgages, it can help with car loans, jobs, credit card, everything. There's so many things tied to this little 3-digit credit score number that putting time on getting it fixed will only benefit you across all financial spectrums. So work on your credit. And knowing why the score is the way it is, you can help get it up a lot faster. All right, let's see how we're doing on time. This is the longest live stream I've ever done, ever. But yeah, we'll keep going. Let's do a couple more, and you can ask questions in the stream. You can jump on whenever you'd like. I love doing your business. I do lending in Utah and Nevada. You can go to ryanbolton.com. In fact, I probably should post that somehow. I'm just using this new system. I mentioned it a few times on the stream. It's called StreamYard. It's been pretty cool so far. I mean, it's like this is the first time I've ever done the live stream feature. I've done some recording with it so far, but I haven't done the live stream feature. And it's kind of nice because it's one video, but it's posting to Facebook and YouTube. And I think I can link other profiles on here too. So I'll have to play with that next time. So it's kind of cool. I'm learning how the cameras work and lighting and posting and content creation, and it's a lot of stuff. I feel like I'm spending more time doing that than I'm doing like all the loans. Loans are easy. This stuff's harder. Loans are a lot easier than all this hashtags. Oh, what the heck's a hashtag? All right, anyway. All right, we'll do... Should we try the rapid fire? I did that one time. I was like rapid fire, and I could never do more than a yes or no because there's so many questions that are not just yes and no. So let's see. Let's say we can do like 5 yes or no's, and that's it. Oh, let's see. How long does it take to eliminate private mortgage insurance? That's not a yes or no question, but it's a good question. So, all right, never mind. We're going to go back to this. How long does it take to eliminate private mortgage insurance? A couple things. If you have an FHA loan, you can't get rid of it until you sell or refinance the loan. But it's not technically private money insurance, it's just mortgage insurance. It's FHA mortgage insurance. So there's just a little bit of a classification there. So if it is truly private mortgage insurance, in most cases, not all, you have to look at the terms of the private mortgage insurer, but in most cases, you have to keep it at least 5 years. Then you don't have to keep it past 10 years. So after the 5-year mark, if you've paid the loan down low enough to where you now have 22% equity or 78% loan to value, you can drop off the mortgage insurance. Now, many companies will not let it be off of the current value of the property because the lender wants to keep that mortgage insurance. It's an added insurance. It's something to make sure that if they have to foreclose, that they get their money back. So they don't necessarily want the mortgage insurance to go away until you sell or refinance the loan. But if it's after 5 years and you've paid the loan down low enough to where you have the 22% equity, then the mortgage insurance can go away. And in many cases, up to 10 years, the mortgage insurance goes away regardless of that loan to value. It can be different. I've seen different mortgage insurance companies have a little different terminology, different verbiage. I have seen a few where you can do a new appraisal at the 5-year mark and show you have the 22% equity. But in most cases, They want to see that you've naturally paid it down under 22% and not have the appreciation be a factor in that. It's case by case. That's the general rule of thumb. I would say 80% of private mortgage insurance falls in that category. The 5% natural pay down, not necessarily appreciation, and then removal after 10 years. But you have to keep it 5. I don't know very many that have less than that 5-year period before it even becomes an option to get rid of it. And if it's an FHA loan, you have to have it for the entire life of the loan unless you put more money down to start. And most people with FHA, I'd love to see the percentage of FHA down payments that are more than the minimum of 3.5%. It's got to be a pretty small percentage. It's got to be well over 80% only put the 3.5% down. That's required on the loan. That's required on the entire life of the loan. I believe it's at 10% down. That's when you can remove it after 10 years. So mortgage insurance with FHA is a lot harder to get rid of without selling or refinancing. But on the private side or the conventional side, there is options after 5 years and after 10 years. That little window is where you can get rid of the mortgage insurance. So great question. Hope that answered that question. Let's do maybe 2 more. Let's find a humdinger of a wonderful question. Hey, this is live, man. Anything can happen on a live stream. Oh, man, this is going to take a minute. Can you explain what a reverse mortgage is and discuss any potential drawbacks associated with this type of loan? Every loan's going to have positive and minus and benefits and disadvantages. The benefit with a reverse mortgage is there's no payment. There's no recourse. There's no foreclosure. You can't foreclose or lose the property because of not making the payment. The downside is it does accrue interest. So instead of having a forward mortgage where you make the payment, the balance goes down, a reverse mortgage, the balance slowly goes up. So interest is on the loan. It does accrue interest. The benefits of it is lower loan to value. If you somehow get upside down, there is mortgage insurance built into the loan that covers that shortfall if it happens to get upside down. It's very rare that reverse mortgages ever do because they loan such a low loan to value, like in the 40% or less, 50% of the value of the home, that it's really difficult for those things to get upside down. But if it does, it is protected by that mortgage insurance. So the benefit is it doesn't have a payment. You could live until you're 200 years old, still collecting Social Security, even up to 225. I saw the Doge thing that said that people were still collecting or on the rolls. I mean, I'm not getting into a political thing, but you can't outlive the loan. So you can get it at 62, never make a payment again. You still have taxes and insurance. You still have to be aware of those things, HOAs. You still have some of those things you have to pay. But as far as a mortgage payment, you don't have a mortgage payment. And usually the rates and things, the home's appreciating at kind of the same way that the rate's eating up. So really the equity is making your payment for you, but your equity is increasing as you own the home. Then once you pass away or move into assisted living, you can assign the home to a family member, a charity, just like you would on a forward mortgage. There wouldn't be any real difference there. That's where I do recommend getting into a estate planner, set up a trust, living will. Really a trust is what you should do, to where you can assign the home to a trustee, a family member, a son, daughter, a church, a charity, whatever you want to do when the home is done. And then once you pass away or move into assisted living for more than 12 months, then that's where the kids can sell it, pay off the balance of the loan, and keep the difference. Split it up amongst the siblings, whatever they're going to do with the money. So it's not like the mortgage company gets to keep the equity after it sells, but there will be a chunk of that equity that's making the payment, so it will eat into that. But mom and dad, don't have a payment. They can live out their life in their home without having to make that mortgage payment. And it really is a smart loan for the right people. It's a perfect loan for everybody? No, of course not. No loan is. But this is one that is really a beneficial loan for the right people. That's why the loan program exists. It's very regulated, got a lot of pluses with it, more than any kind of minuses with it. But the misconceptions I hear the most is that they don't have a mortgage payment anymore, but there's still interest accruing on the loan. So the balance does go up. Many people don't realize that factor and the cost to get the loan is more expensive. It's a very much more expensive loan than just a regular conventional loan. So the costs are more expensive, no payment, can't outlive the loan. Interest does eat into the equity. It does increase. So that's kind of a really quick overview on reverse mortgages. It's 7:30. Holy moly. I don't know when you're watching this, but this is 7:30 p.m., so I think we're going to wrap this one up. I didn't mean to go that long, but I like this stuff. I like talking about it. I like answering questions. I like what I do for a living, and I really would love to earn your business if you're looking to purchase or refinance a home. That's why I have this Facebook page, this YouTube channel, is I really do enjoy this. I've been doing it since 1999, helped a lot of people buy homes, refinance, divorce situations, investors, lines of credit, anything with real estate. I often tell people I sell money for a living, and that's what I like to do and problem solve. There's so many problem-solving aspects of this industry that make it fun, and why I'm still doing it for as long as I have. Is every client comes in, it's a little different. There's always little things that are a little bit different with every client. And like I said, we have all these boxes and guidelines and ways to fit people into homes and different programs that have little different benefits and disadvantages for each client. That's just part of my job, is to know what's going to fit any client that walks in the door. And it makes it exciting to be part of this business and helping my clients. So if you're a real estate agent, if you're a builder or a buyer or seller, and you need somebody to help you with your mortgage or help with financing, I'd love to earn your business. You can check out my website at ryanbolton.com. It has a great mortgage calculator that you don't have to sign up or give you email or any of that stuff. Is right on the website. I really like how it's just a very user-friendly kind of mortgage calculator if you need help with that. But I'd love to earn your business. And if you're looking to buy a home, start early. We've talked about that almost the entire show today. Whether you're a first-time home buyer, upgrade buyer, start early. I can help you with bridge loans. I can help you first-time home buyer. I can help you with any loan that's out there in the marketplace, and I'd love to earn your business on your next home loan. So check me out at ryanbolton.com. Like, subscribe, and we'll see you on the next stream. This was pretty fun. I'm going to play with this little StreamYard thing a little bit further, and we'll come back on another show, and love to earn your business. Check out ryanbolton.com, and we'll see you next time.